Hello and welcome to Session 7 of the Basic Tax course. We're going to begin Session 7 with a review of the Session 5 quiz answer key. I have up in front of you here the Session 5 quiz, and the first most frequently missed question is number 1. Mary, born in 1935, retired during the year. She decided to take $30,000 from her pension as a lump sum distribution. She will take the remaining balance in her plan as a pension of $400 each month for the rest of her life. How much of Mary's lump sum distribution is eligible for the 10-year tax option on Form 4972? Well, the correct answer is none of it. And as I said in session number 5, the lump sum distribution is a topic that does get tested and does still exist in tax law, so I teach it. But the reality is almost no one qualifies for it. And the reason Mary doesn't qualify for it is she didn't actually take a lump sum distribution per the definition. To have a lump sum distribution, you have to take all of the money out of the plan at one time the first time you ever take a distribution. You also have to have been born before 1936, and so Mary does pass the born before 1936 rule, but she does not pass the lump sum test itself, which is, did she take a lump sum amount? And the answer is no. She took a certain amount of money out, $30,000, but it wasn't all of the plan. It was only a part of the plan. Question number 3. You are married filing separate, and you did not live with your spouse at any time during the year. Your income consisted of $19,000 of pension income and $1,000 of municipal bond interest. You also received $12,000 of Social Security benefits. How much of your Social Security benefits is taxable on your return? And this question, I've had it in our basic tax course since the very first year I taught it. It's been 10 years now, and it's always a frequently missed question. And I don't want to say I'm mean, but I do have high expectations at this point. And the expectation that I have is that you understand how the Social Security benefit worksheet works well enough that you actually don't need it. And in this case, you just simply don't need it. And let's look at why. Remember the rules for calculating the taxability of Social Security. You take all of the taxable income plus tax-exempt interest. You then add in half of the Social Security benefits. And if that number exceeds the base amount for your filing status, then some of your benefits become taxable. So what do? You take all of the income that there was, $19,000 of pension income. You then add in $1,000 of municipal bond interest and 1/2 of the Social Security benefits. So half of 12 is 6. So therefore we take 19 plus 1 plus 6, and we get $26,000. The next test is, what is the base amount for married filing separate if you did not live with your spouse? And the answer is $25,000. So you're going to take 25 from 26, and that gives you $1,000. $1,000 is less than the second base amount that we see on the Social Security benefit worksheet for a married filing separate person who did not live with their spouse or a single person. And that is $9,000. Well, 1,000 is less than 9,000, so the next step on the worksheet is to divide that result in 2, and you get $500. Now, there are other steps on the worksheet which say take the total Social Security benefits, multiply them by 85%, and then take the lesser of the number from the first calculation or the second calculation. No matter which way you cut it, you come back to the same result every time, which is $500. Moving on, the next most frequently missed question was question number 7. Generally, you must begin to receive distributions from your retirement plan the year you reach age 70.5 or the year in which you retire, whichever is later. And that is a false statement. The reason is that it is April 1st of the year following the year you reach age 70.5. It is not the year you reach age 70.5. Number 9, Jack, age 66, had been participating in his company's pension plan since 1990. Jack has retired and will take all funds from his pension plan as a lump sum distribution. Jack is eligible for the 10-year tax option. And the answer is false. The reason is he did take a lump sum distribution. He emptied out his plan, but he's not old enough. He wasn't born before 1936. At age 66, he was born later than 1936. He was born in the 40s. Moving on, The next most frequently missed question was question number 15. Contributions to a Section 401k plan are considered pre-tax contributions to the extent they are not includable in the employee's income for the year in which they are made. I'm not sure why people answer false to that question. The answer is true. Essentially, what happens when you contribute money to a 401k, you do so through salary deferral. That is, the taxable income showing on your W-2 is reduced by the amount you put in your into your 401k plan. And to the extent that your taxable income is reduced, it means that you are making pre-tax contributions, and pre-tax contributions do not add to your basis for tax purposes in the plan. Moving on. Question number 19. Sandy Lee is single, age 66, and retired. During the year, she received $4,000 of interest income, $5,000 of Social Security income, and $3,000 of pension income. Sandy is required to file a tax return, and of course most people answered true when in fact the answer is false. Now we're going back to session 1 and saying, how do you calculate whether or not, or determine whether or not a person is required to file a return? Well, you go to their age. She's age 65 or older. So you then say, is she a dependent? Well, we don't really answer that question, but let's assume she's not a dependent because we didn't tell you that she was. So Sandy, we have to look at what her filing requirement is, and it's going to be $36.50 right here. That's her personal exemption amount, plus the extra standard deduction she gets for being age 65 or older, plus the base standard deduction amount of $5,700. That means her income has to exceed $10,750 before she is required to file a tax return. Now, at this level of income, if we look at her income, she has $4,000 of interest and $3,000 of pension. If you take those two numbers and add them together, you get $7,000. You then add in half of her Social Security benefits, which would be $2,500, and you do not exceed the base amount for taxability of Social Security. That is, her income would not exceed that $25,000 base amount. Therefore, none of her benefits are taxable. So let's just take this income and add it up again. $4,000 plus $3,000 is less than $10,750. She is not required to file a tax return. Remember, when we're looking at filing requirement, we take into account only taxable Social Security. Her income is low enough that none of her Social Security is taxable. So the answer to B is false. She is not required to file. The next most frequently missed question was the mini problem. And this mini problem almost universally causes problems because the students do not read the question correctly and remember the rule about age. So let's take a look at the mini problem together. Jonathan, born in 1943, and Martha, born in 1945, are married. Jonathan retired from his job with the U.S. Postal Service on June 1, 2008, after 30 years of service. The tax-free portion of the annuity recovered in 2008 and 2009 was $1,838. During the year, the Kents had the following combined sources of income, and we have savings account interest, tax-exempt interest, the annuity for Mr. Kent, gambling winnings, and Social Security benefits. Jonathan's annuity is payable for his life and that of his beneficiary, Martha. The Kents will file a joint return using the attached worksheets to determine the taxable portion of the Kents' annuity and the taxable portion of their Social Security benefits. Okay, well, this is a two-step problem, making it a fairly complex problem, one of the more complex mini problems we throw at you during this course. And we're really trying to drill in 2 points. One is that you have to do the simplified general rule first because the taxability of the Social Security benefits is going to be dependent upon the taxable income flowing through from that annuity. And then in looking at the annuity, you're going to have to use the simplified general rule worksheet to determine the taxability of their benefit. The next thing to look at is, of course, the simplified general worksheet itself. So let me go to the answer key and find that for you. And here is the simplified method worksheet for the Kents. The first thing I'm going to draw your attention to is the combined age at the annuity start dates. And we have to look to the age of the Kents. So I'm just going to scroll up a little to the narration part of this problem where we describe what we've done. This is an annuity that is payable for the life of the annuitant and his beneficiary, Martha. you have to look at the age at retirement and not the current age. And Jonathan's age at retirement was 65, and Martha's age was 63. You take those two ages and combine them, and you get 128. And then you go to the table and see where they fall. And they fall at the 121 to 130 range, giving them a factor of 310. The next step is to take the cost in the plan, which is shown on the annuity statement, and divide that by 310, and you get 96.77. Multiply that by the number of payments received during the year, and you get 1,116. 1,116 is the amount that they can receive tax-free for the year, and you subtract it from the gross benefits for the year. The difference is 23,839, and that is the taxable benefits that they received. The second part of this problem is to figure the taxability of their Social Security benefits. And the starting point is to take the gross benefits for the year, divide them in half. We then take all other income they received for the year, including interest and the taxable portion of their pension. And then you add in tax-exempt interest. So we take these three numbers, $7,500, all other income plus tax-exempt interest, and we get $35,439. We go to the base amount for their filing status, which is $32,000, subtract that out, and we get $34,039. The next step is to look at what their second base amount is based on their filing status. That's $12,000. Their total income after subtracting this first base amount of $32,000 is only $34,039. So at this point mentally I know I'm done with the equation. I'm simply going to take $34,039, divide that in two, and I have the amount of their Social Security benefits that will ultimately be taxed. The worksheet does carry you through more steps than that, but ultimately it does get to that point because this number on line 10 is less than this number on line 11. That makes the rest of the equation easy. Now, if the number on line 10 is greater than the number on line 11, then more computations really are required, other than just taking line 10 and dividing it in half. So that concludes the review of the Session 5 quiz answer key. If you have any more questions, please use the Q&A forum to post them. And here I have in front of us the homework assignment for Session 6. If you recall, the assignment for Session 6 was two parts. Homework A asking you to determine the maximum amount that a particular individual can contribute to his or her Roth account. And Part 2, or Homework B rather, involved preparation of a tax return for the solos. But let's take a look at Homework A first. Number 1, Todd, age 50, is married to Martha, age 49. Martha earned $40,000 working for ABC Company, and Todd earned $120,000 working for Intel. They received $20,000 of taxable interest and $1,500 of non-taxable interest. They made no traditional IRA contributions. So what is their allowable Roth contribution going to be? Well, here is the answer key, and this is the answer. The ACRES modified adjusted gross income, when you add it up, is greater than $177,000, so they are not allowed to make a contribution to their Roth IRA at all. They can make contributions to their traditional IRA. If they are covered by a pension plan at work, they would not be allowed to take a deduction for it. If they are not covered by a pension plan at work, either of them that is, then they would be allowed to take a deduction on their tax return. Question number 2. If Todd and Martha file married filings separate, what would their allowable Roth contributions be? Well, in reality, not much changes, because if they file married filings separate, the phase-out range for contributing to a Roth is anywhere from $0 to $10,000. Since their income exceeds $10,000, even when they file separately, no Roth contribution is allowed. Number 3, Jake Edwards, age 35, is filing married filings separate. He did not live with his spouse during the year, and he earned $85,000. He contributed $1,000 to his traditional IRA. What is his maximum Roth contribution? Well, here we're looking strictly at income, and the phase-out is important. The phase-out is 105 to 120, but his income is less than that, so he is allowed to make a full contribution to his Roth, and depending on his age, he would be allowed to contribute the difference between what he put in his traditional IRA and the amount he put in his Roth. Since he's already put $1,000 into his traditional IRA, then the remaining amount would be either $4,000 if he is under age 50 or $5,000 if he is age 50 or older, each of those respectively being, based on his age, the maximum amount he could contribute to his Roth. And finally, Tasma, age 35, and Harry, age 30, are married. Their modified adjusted gross income is $171,000 on their joint return. What is their maximum Roth contribution? Well, Tasma and Harry are phasing out on their allowable contribution. Remember that the maximum they can earn and still contribute to a Roth is $177,000, and they are 40% of the way into the phase-out range based on their filing status. So what that means is, based on their age, they would be allowed to contribute 60% of the maximum amount. So if they are under age 50, they would be allowed to contribute 60% of $5,000, and if they are age 50 or older, they would be allowed to contribute 60% of $6,000. Those numbers being either $3,000 or $3,600 respectively. Moving on to homework assignment B for the solos. We made you do a little bit of work here and a little bit of thinking, of course. It's all part of becoming a tax preparer, learning how all of these things meld together when you're thinking your way through the problem of preparing a tax return and the solution being the forms and how to fill them out correctly. Leah Solo is a nurse who moved to Charlotte, North Carolina on January 1, 2010 with her husband Han, who is an airline pilot. Han's employer paid all of their moving expenses for them. They reside at 6060 Millennium Drive in Charlotte, North Carolina. They have a daughter named Alexandra who lived with them all year. Year of birth is important. She is obviously 11 years old at this point, so she should be qualifying for the child tax credit at that age. Han contributed $2,500 to his qualified family coverage HSA during the year. His annual HSA deductible is $5,000, and during the year he withdrew $2,000 to pay for unreimbursed qualified medical expenses. So we have a $2,500 contribution up here. We also have employer contributions showing here of $2,000. You can see the W-2 shows the code W. That means employer contributions to a health savings account. But on top of that, Han also contributed $2,500. And during the year, he withdrew $2,000. So we're going to be showing contributions in Part 1 of the 8889 form, and we're going to be showing distributions down in Part 2. Leah and Han want to make the maximum deductible IRA contributions that they can, and then contribute the balance to their Roth account. So any non-deductible amount they want to put into their Roth. Now, during the year, Leah paid $1,500 of qualified student loan interest and received $12,000 of unemployment. The solos will receive the Making Work Pay credit in the amount of $800. Their W-2s and 1099-R are attached to prepare their federal tax return and then answer the questions. So as a reminder, let's look at their W-2s. Han Solo has a W-2 showing $46,000 of income. He is participating in a pension plan. You can see code D means he made salary deferral to a 401k plan in the amount of $1,000. Also, the retirement plan box is checked. And we can see the code W again means he has employer contributions to his health savings account. Leah's W-2 shows $40,000 of income. Her pension plan box is not checked. We also have a distribution from a 401k or pension plan. It is an early distribution. The IRA box is not checked. And then let's move on and take a look at their finished return. So Han and Leah's modified adjusted gross income is $96,500. That's when you take up all of the income that they had for the year. And since Han is an active participant in his company's plan, he is not eligible to claim a full IRA deduction. So you're going to calculate his maximum allowable deduction by attaching the Form 8606 worksheet. Now, since the solo's modified adjusted gross income is less than $177,000 and Leah is not an active participant in her employer's plan, she ultimately does get a full deduction for her contributions to her IRA. Actually, the phase-out is $167 to $177, and their income is also less than $167. Han is going to complete the Form 8889 and claim a deduction for the $2,500 contribution that he made, and Leah will claim $1,500 of student loan interest expense as a deduction on her tax return. Moving over to the Form 1040, let's just take a look at the front. We see that we have the filing status married, filing joint. We have their daughter who is eligible for the child tax credit and a total of 3 exemptions. The income from wages is $86,000. We're showing we're showing the pension distribution on line 16. And we are showing also unemployment compensation that was received for the year in the amount of $12,000. That gives us gross income or total income of $99,000. Next step is to figure the adjustments to income, and ultimately we are going to be able to claim $2,500 as an HSA deduction, but we'll need to attach the Form 8889 to show how we computed that. And the IRA deduction will end up being $8,130. Ultimately, Leah is allowed a full $5,000 deduction, and Han is going to be allowed a $3,130 deduction. We'll do the 8606 worksheet to figure where those numbers came from. And then we have the student loan interest deduction. We end up with $1,500 as being the student loan interest deduction. That gives us adjustments to income of $12,130 and adjusted gross income of $86,870. On page 2 of the Form 1040, we figure the tax at $88.41. Child tax credit of $1,000 comes off, giving us taxable income of on line 55 of $7,841. We gave you no information of any kind that would have made Han or Leah eligible to claim the exception to the early distribution penalty, so that $100 penalty does apply. That is 10% of $1,000. There is no need to attach Form 5329, so we've written the word no next to that, meaning no, it's not required. And of course we have $6,200 withholding on 1099 forms and W-2s combined, an $800 making work pay credit. It's not enough. Total withholdings end up being $7,000, and the tax bill is $79.41. So of course we owe $941 with the return. Here is Form 8889 for Leah and Han Solo. You can see that this is a family plan. Contributions to the plan by Han. The maximum amount that can be contributed to the plan based on family and age. Also employer contributions, and you have to add these employer contributions to this to make sure you haven't exceeded the maximum allowable contributions to the plan. But we're good to go. All $2,500 is deductible. Now in Part 2 of the form, we show the distributions that were made, the portion of those distributions that were spent on qualifying expenses, and of course that leaves us taxable distributions of 0 because they were all spent on qualifying expenses. The making work pay credit. We throw this making work pay credit into every problem because it's a fundamental aspect of 2010 law. However, the rule relating to the making work pay credit was in place for 2009, 2010 only, and students who are taking the basic tax course this year will not be seeing Schedule M on any future tax returns after 2010. So we will cover the rules for when a person is allowed to claim this particular credit, but we really don't want you spending time figuring it simply because it's going to be an obsolete rule, or an obsolete form rather. Moving on, the next form in line to review is the IRA deduction worksheet. And we have this IRA deduction worksheet laid out with the taxpayer and spouse. And one of the problems that we have found over the years for our students is the students will put Han's name first on the form, even though we've provided Leah's name first in the problem. And when we provide Leah's name first in the problem, we mean she is the taxpayer, and her name will go first on the tax return. And since her name is first on the tax return, her name will be first on the Form 8606 IRA deduction worksheet. So there is comments I've had over the years are, you mean the woman's name can be first on the tax return? I thought the man had to go first. Actually, that's not the case at all, and it's rather an archaic way of thinking if you think about it a little bit. But it is such a common way of thinking that I feel it's worth talking about. Absolutely, there is no rule that says the man's name must go first on the tax return, and in fact, a woman can have her name first anytime she wants. Of course, the husband and her signing a joint return usually have to agree on that. So at the beginning of any interview I have with clients where they are filing with me for the first time, the question I will ask them is the all-important question: whose name is going first on the tax return? And some clients go and shrug their shoulders and are very polite, and neither wants to claim first place. And other times the husband says, oh, put me first, or the wife says, oh, put me first. Very often it boils down to who's attending the interview. If I have one spouse present in the interview and the other is not present, the person who is present may say, yeah, put my name first. It just simply doesn't matter, however, except in our problems, you certainly want to make sure that you're filling the worksheet out appropriately. And in this worksheet, Leah's name is first, and so when we ask the question, do you have an IRA at work? The answer for Leah is no, she does not. When we go over to Han, who is the spouse, does he have a pension plan at work? The answer is yes. So from that point forward, we're selecting $177,000 as the threshold amount for Leah and $109,000 as the threshold amount for Han. And we can see then, based on these calculations, that the income for Han puts him into the phase-out range, but the income for Leah means that she is not in the phase-out range. And thus, Leah is allowed a full deduction for the amount she contributes to her IRA, but in the end, Han is only allowed a partial deduction of $3,130. And of course, that means that the balance that he will have to put into his Roth IRA account is $1,870. So that concludes the review of the Session 6 homework assignment. It is now time to push pause on the video playback and take the Session 6 quiz. And when you're ready, resume playback for the Session 7 lecture. All right, and here we are with Session 7. Today's class covers itemized deductions, and as I told you at the end of last session, I like to talk about deductions because they're ways we can save our clients money. Of course, it's really important to know when income is taxable and when it's not, and the rules for determining taxability of income. That's crucial to any tax return. But as tax preparers, our clients very often pay us to make sure that we're maximizing the deductions they can legally claim. And in order to do that, you obviously have to know what those deductions are and who qualifies for them. Today we're looking at Schedule A, and I'm just going to call that up for you real quick. Schedule A is a multi-line form divided into sections. So let's just orient ourselves a little bit with it for now. The first section of Schedule A is used to calculate medical and dental expense deductions. We then have another section devoted to figuring deductible taxes that you may have paid. Then we move on to interest expenses you paid that could be deductible, and charity contributions that can be deductible. And we're going to cover all of these sections today. That is medical and dental, taxes, interest, and gifts to charity. Each of these sections are a part of today's class. Other sections of the form that we're going to cover in our next session or two include casualty and theft losses, job expenses and certain miscellaneous deductions, and other miscellaneous deductions. So for today, we're going to focus on this top part right up here, medical and dental expenses, and here we go. Actually, before we get going, let's just talk about the Schedule A itself and who uses it. You use Schedule A to figure your itemized deductions. In most cases, your federal income tax will be less if you take the larger of your itemized deductions or your standard deduction. If you itemize, you can deduct amounts you paid for certain taxes, interest, and contributions. You may also be able to deduct a part of your medical and dental expenses, unreimbursed employee business expenses, and miscellaneous expenses. You can also deduct certain casualty and theft losses. So let's look at a couple of rules. One is almost everyone is entitled to a standard deduction, and when you're making a decision about whether or not to itemize your deductions, typically you're going to itemize only if your itemized deductions are greater than your standard deduction. What's interesting about itemized deductions is that at the federal level, they may be less than your standard deduction, so you would choose the standard deduction at the federal level. But many states also allow individuals to itemize. And when you are itemizing deductions, you should also pay attention to the rules at your state's level. For example, in the state of California, as well as in the state of Oregon, you are allowed to itemize your deductions. And the itemized deductions you can claim on the California or Oregon return are often similar to the itemized deductions on the federal return. and often they are less. So it's not uncommon for the state itemized deductions to be less than the federal. Thing is that the state standard deduction is also usually much less than the federal deduction. So you may find that even though you do not have enough to itemize on your federal return, you still have enough to itemize on your state return. Now, we do offer state tax law education for both the state of California and the state of Oregon, and if you are interested in either of those states and how itemized deductions are calculated, we certainly invite you to take some of our sessions in that respect. But outside of California and Oregon, we do not have at this time any training programs in place specific to other states. So as a tax practitioner, it would be up to you to research and learn about the itemized deduction rules for your particular state. But going back to federal law, who must itemize deductions? Because remember, we said for most people, you can choose the standard deduction or you may itemize your deductions, and if itemizing is better, you go with that. If the standard is better, you go with that. But there are situations when you are required to itemize your deductions. You must itemize your deductions if either of the following is true. You are married filing separate and your spouse itemizes deductions on his or her return, or you are a non-resident alien filing Form 1040-NR. Get this, however, residents of India are allowed to claim a standard deduction on their 1040-NR form, but only residents of India. Who should itemize deductions? Well, you should itemize deductions if your total itemized deductions are more than your standard deduction. So what are the itemized deductions? Itemized deductions are deductions you claim instead of the standard deduction. You can either itemize or you can claim the standard deduction, but never both. Itemized deductions are reported on Schedule A, Form 1040, and you cannot itemize deductions on the short forms 1040EZ or 1040A. If your itemized deductions are greater than your standard deduction, it is more beneficial for you to itemize. There is, of course, an important rule to remember for all itemized deductions, and that is no double deducting. You must use after-tax dollars to pay an expense you wish to claim as a deduction. For example, if you participate in a pre-tax health care plan at work, you cannot claim the cost of the plan as an itemized deduction on your Form 1040 Schedule A. So remember how we showed you a W-2 where it is possible to salary defer to a 401k plan, and by salary deferring to a 401k plan, you reduce the amount of taxable income you have showing in Box 1 on your W-2. It's also possible to participate in a plan at work that will allow you to salary defer to pay for health insurance or some other kind of health savings account at work. And I need to remind you that anytime you do salary deferral at work, it means you are not using taxed dollars to make those deferrals. In fact, you're getting a deduction right off the W-2, and so if you do it there, you cannot claim it again on the Schedule A. Now, you may be thinking, oh, that's pretty self-evident, I get that part, move on with it. But here's the thing, as a tax preparer, you may know this, or at least you should know this now that I've told you, but your clients don't know this. And when they bring you a list of medical expenses, it's your job to ask them, were these expenses paid through your job at work, or did you write them out of your checking account, or did you pay them with a credit card? Did you pay them from funds inside a health savings account or a medical savings account at work? These are very important questions because your client doesn't often understand when something is and is not deductible, and they will bring you numbers and say, here are my deductible expenses, and it's your job as the preparer to verify that they are in fact deductible. Now let's move on to medical and dental expenses and what actually can be deducted and when I can deduct them. You can claim allowable medical expenses as a deduction on Schedule A, Form 1040, for those expenses that exceed 7.5% of your AGI. I'm just going to go over to the Schedule A right here and zoom in on it a little. I want to draw your attention to a couple of lines here. You'll see line 1 says total medical and dental expenses that you had. See the instructions. The instructions tell you what's deductible and what's not. When you ultimately determine what is deductible, you're going to enter that amount on line 1. Then on line 2, it says enter the amount from your Form 1040, line 38. Well, let's just see what line 38 is. Line 38 is your adjusted gross income. So you're going to enter the amount from your adjusted gross income on line 2 of Schedule A. You then multiply your adjusted gross income on line 2 by 7.5%, and you get a number. Your medical expenses are deductible to the extent that line 1 is greater than line 3. So you have to subtract line 3 from line 1, and then you enter the difference on line 4. Unfortunately, for most filers, it means that they do not get to claim a deduction at all. 7.5% of your income is a really big number. Your expenses have to have been really high in proportion to your income to become deductible. But here's a tip. If you normally would not have enough medical expenses in a single year to exceed the 7.5% rule, then you should plan to pay your expenses in the most advantageous way. And here is an example. David's adjusted gross income is $40,000, and he has scheduled a $3,200 corrective eye laser surgery for January of 2011. Now, during 2010, he paid $2,000 of other deductible medical expenses. If David pays for his eye surgery bill in 2011, his other 2010 medical expenses are not going to be enough to exceed the 7.5% limit. $40,000 times 7.5% is $3,000. However, if David pays for his corrective surgery in December of 2010, his allowable medical expenses for 2010 will go from $2,000 to $5,200. And then he would be able to claim $2,200 as a medical deduction, because we would take the total combined paid medical expenses of $5,200, subtract out 7.5% of his income, and the balance of $2,200 would carry over to the Form Schedule A. So ultimately, how would things look for him? Well, let's just suppose that we have $5,200 of medical expenses being entered on line 1. Then on line 2, we enter the adjusted gross income multiplied by 7.5%. That, this number goes on line 3. There we go. And on line 2, we enter his adjusted gross income, which is $40,000. And then the next step is to enter the difference between line 1 and line 3 on line 4, and that's where we get $2,200. So this type of thinking should be in your mind all the time. If we're talking about the amount of medical expense, we enter that on line 1. If we're talking about the amount of AGI, we enter that on line 2. If we're looking at the limit, we enter that on line 3. And if we're thinking about the deduction, we enter that on line 4. So whose medical expenses can you deduct? You can deduct medical expenses you pay for yourself and the following individuals, provided they were paid during 2010. Now, medical expenses, like most other expenses, are deductible if you incurred the debt, you're liable for the debt, and you paid the debt. If you're not liable for the debt but you paid it, you typically aren't allowed to deduct it. And if you are liable for the debt but someone else paid it for you, you're typically not allowed to deduct it. Medical expense takes it one step further and says that you can only claim medical expenses that you pay for people who are essentially your dependents or your spouse or yourself. So let's look at these rules. You can deduct medical expenses you pay for yourself and the following individuals, provided they were paid during the year 2010. Number 1, your spouse. If married filing separate, you can claim expenses you paid for your spouse, only if you paid them after you were married. If married filing joint, you can claim expenses you paid for your spouse at any time during the year, so long as you were married on the last day of the year. You can also claim expenses you paid for your dependent. This person must have been your dependent either at the time the expense was paid or at the time the medical services were provided. You do not need to claim a dependency exemption for your dependent. For purposes of the medical expense deduction, a person qualifies as your dependent if both of the following requirements are met. The person was a qualifying child or a qualifying relative, and the person was a U.S. citizen or national or a resident of the United States, Canada, or Mexico. So what is a qualifying child? Well, a qualifying child is a child who is your son, daughter, stepchild, foster child, brother, sister, stepbrother, stepsister, half-brother, half-sister, or a descendant of any of them. For example, your grandchild, niece, or nephew, and who at the end of 2010 was under age 19 and younger than you, or your spouse if you're filing jointly, under age 24, a full-time student and younger than you, or your spouse if married filing jointly, or any age and permanently and totally disabled during the year. Also, this person must have lived with you for more than half the year and did not provide more than half of his or her own support for the year and did not file a joint return other than to claim a refund. Adopted child. A legally adopted child is treated as your own child, and this includes a child lawfully placed with you for legal adoption. You can include medical expenses that you paid for a child before adoption if the child qualified as your dependent when the medical services were provided or when the expenses were paid. Child of divorced or separated parents. For purposes of the medical and dental expenses deduction, a child of divorced or separated parents can be treated as a dependent of both parents. Each parent can include the medical expenses he or she pays for the child, even if the other parent claims that child's dependency exemption. If the child is in the custody of one or both parents for more than half the year, the child receives over half of his or her support during the year from his or her parents, and the child's parents are divorced or legally separated under a decree of divorce or separate maintenance, are separated under a written separation agreement, or lived apart at all times during the last 6 months of the year. But note that this rule does not apply if the child's exemption is being claimed under a multiple support agreement. So what we're saying with child of divorced or separated parents is that ultimately you can have a child who is being claimed as a dependent on one parent's tax return, but the other parent has incurred and paid medical expenses, or not even necessarily incurred, but has paid medical expenses for that child. The parent that pays the expenses is the parent that gets to deduct them, regardless of whether or not that parent is the one who is claiming that child's exemption. And the only exception to that rule is if the child is not being claimed as a dependent by either parent because either they supported themselves or they're being claimed by someone else, or the child's dependency exemption is being claimed under a multiple support agreement. Qualifying relative. So you can claim expenses you paid for your qualifying child. You can also claim expenses you paid for a qualifying relative. And a qualifying relative is a person who is your son, daughter, stepchild, foster child, or descendant of any of them, for example, your grandchild, or your brother, sister, half-brother, half-sister, or a son or daughter of either of them. And father, mother, or an ancestor or sibling of either of them. For example, your grandmother, grandfather, aunt, or uncle. Your stepbrother, stepsister, stepfather, stepmother, son-in-law, daughter-in-law, father-in-law, mother-in-law, brother-in-law, or sister-in-law, or any other person other than your spouse who lived with you at all year as a member of your household, if your relationship does not violate local law. So you can see this definition of qualifying relative is hinging really on the same definition that would qualify a person or for a person that would qualify you as head of household. In other words, that person has to be related to you through blood or marriage. And when we're talking blood, a cousin would not qualify, but a niece or nephew, aunt or uncle would. Also, the person was not the qualifying child of anyone else for 2010, and you must have provided over half of this person's support, but see children of divorced or separated parents earlier and then support claimed under a multiple support agreement, which is right next. And here we are. What happens if you are paying or providing support for a qualifying relative under a multiple support agreement? If you are considered to have provided more than half of a qualifying relative's support under a multiple support agreement, you can include medical expenses you paid for that person. A multiple support agreement is used when two or more people provide more than half of a person's support, but no one alone provides more than half. Any medical expenses paid by others who join you in the agreement cannot be included as medical expenses by anyone. However, you can include the entire unreimbursed amount you paid for medical expenses. Antecedent, if you paid medical expenses for your deceased spouse or dependent, include them as medical expenses on your Schedule A, Form 1040, in the year they are paid, whether they are paid before or after the decedent's death. The expenses can be included if the person was your spouse or dependent, either at the time the medical services were provided or at the time you paid the expenses. So that's who you can deduct medical expenses for. Now we're going to look at what expenses are deductible. Firstly, we have insurance premiums. Medical insurance premiums are deductible, and these include premiums paid with, assuming they are paid with after-tax dollars, that cover hospital care, surgery, etc., prescription drugs, dental care, contact lenses and glasses, also group or co-op care, long-term care, and Medicare B and Medicare D. Self-employed health insurance premiums. If you had a net profit from self-employment and neither you nor your spouse was eligible to participate in a subsidized employer plan during the year, then you can claim up to 100% of the cost of your health insurance premiums as an adjustment on Form 1040, line 29. And let me just point out what we're getting there. We covered, of course, adjustments to income just last session in Session 6. And this is a reminder that if you are eligible, you can claim self-employed health insurance premiums as a deduction on line 29 of the Form 1040. Of course, you're not limited by 7.5% of your income there, but you are limited by other factors such as the overall deductibility of the premiums to begin with. Moving over to the Schedule A again, we have the amounts that are deductible on Schedule A, and you can deduct long-term health care insurance premiums, you can deduct self-employed health insurance premiums on Schedule A or as an adjustment to income, but of course you cannot do both. Next, we move on to the limit on long-term care insurance premiums that you can deduct. A qualified long-term care insurance contract is an insurance contract that provides only coverage of qualified long-term care services. The contract must be guaranteed renewable, not provide for a cash surrender value or other money that can be paid, assigned, pledged, or borrowed, provide that refunds other than refunds on the death of the insured or complete surrender or cancellation of the contract, and dividends under the contract must be used only to reduce future premiums or increase future benefits, and generally not pay or reimburse expenses incurred for services or items that would be reimbursed under Medicare, except where Medicare is a secondary payer or the contract makes per diem or other periodic payments without regard to the expenses. The amount you can deduct for qualified long-term care insurance contracts depends on your age at the end of 2010. And so we look at the ages, and it says that if you are age 40 or under, the most you are allowed to deduct for premiums paid for long-term care insurance is $330. When you hit age 71 or older, the cap moves up as high as $4,110. So essentially, what are long-term care insurance premiums? I frequently ask clients if they have paid these. Very few clients have, but I just do have a good number of you who have paid them. So who tends to pay for these long-term care insurance premiums? Well, just my casual observation as a tax preparer is if I'm dealing with a middle-aged client, say someone getting into their mid-40s, into their 50s, who has no children, those are the types of individuals I frequently see starting to purchase these long-term care insurance premiums. But young people and even middle-aged people with kids tend to not buy them. And my theory behind all of this is that if you do not have children, you may be putting some thought ahead in your life to what's going to happen when you're no longer able to care for yourself and you need to go into a nursing home or you need someone to take care of you. And so it's with those thoughts in mind that individuals purchase long-term care insurance, because traditional health insurance does not cover nursing home care beyond the first 30 days, and nursing home care is extremely expensive. It can easily be $4,000 per month to be in an assisted care living center or higher, depending on the center. And so individuals who know that their health insurance is not going to cover that if they need a nursing home may look to long-term care insurance and purchase that with that kind of long-term goal in mind. But again, just as a casual observation, this kind of insurance seems to be favored by middle-aged people with no children. But of course, there's no rule that says you won't have a person in their 30s with children who's already started to invest in it. Next up, we're going to look at the deductibility of meals and lodging as a medical expense. You may deduct the cost of meals and lodging at a hospital or similar institution if your main reason for being there is to receive medical care. You may deduct the cost of lodging while away from home even though you are not staying at a hospital or similar institution, provided all of the following is true. The lodging is primarily for and essential to medical care. The facility is related to or the equivalent of a licensed hospital. The lodging is not lavish or extravagant. There is no significant element of personal pleasure. The cost for lodging cannot exceed $50 per person per night, and you may not deduct the cost of meals. nursing home, or home for the aged. Expenses are allowable for you, your spouse, or your dependents, including the cost of meals and lodging, provided you are there for medical or nursing care reasons. Transportation. Allowable medical expenses for transportation include bus, taxi, train, airfare, or ambulance. Transportation expenses of a parent who needs to accompany a child who needs medical care. Transportation expenses of a nurse or another person who must accompany a person to provide medical treatment when that person is unable to do so alone, as well as transportation expenses to visit a mentally ill dependent if those visits are prescribed as a part of that patient's treatment. But transportation expenses are not allowed for commute to and from work, nor is transportation deductible if it is for a non-medical reason. Example, you travel to Hawaii for medical treatment that is available to you in your hometown. So what kind of transportation expenses are deductible? Well, you can deduct car expenses as well. You can claim a standard rate of 16.5 cents per mile or the cost of gas and oil. There is no allowance for depreciation or maintenance. Disabled dependent care expenses. You may be able to claim certain disabled dependent care expenses as a medical deduction or as a dependent care credit. Either way is allowable, but remember you cannot double deduct by claiming both a deduction and a credit for the same expense. You can claim either the deduction or the credit, but not both. And so let's just think about what we're talking about here. The Form W-2 does have space on it for dependent care benefits, and dependent care benefits are a method by which a person can do salary deferral at work to pay for child care. You can also just pay out of pocket for child care. You can also pay out of pocket for dependent care for a person who is incapable of self-care. And in certain situations, you may be paying for dependent care for a person who is qualifying for the child and dependent care credit. And if a person qualifies for this credit on the same expense that you could qualify to claim a medical deduction for, you're obviously not allowed to double benefit on those items. We're going to look more at the child and dependent care credit later on in our course when we get into deductible credit items. So here is a list of some other medical expenses that you can deduct or include as a deduction on your return. A summary of the most common medical expenses you can and cannot deduct is located in Pub 17 on page 142. As a general rule of thumb, you can claim a medical expense if the treatment is prescribed by a doctor to address a medical need. The treatment is related to your health or a diagnosed medical condition. The treatment is not purely cosmetic and holds a valid medical benefit. For example, eye laser surgery can correct myopia and is allowed, but a facelift for purely cosmetic reasons or teeth whitening is not allowable. The treatment cannot violate the law, and the expense must be for equipment or home improvements needed to accommodate a medical need. So, for example, if you are going to claim deduction for home improvements, they would need to be things like wheelchair ramps, guide dogs, lead paint removal, etc. Publication 502 has more information on those types of expenses and how to deduct them as medical expenses. Also, you can claim a deduction for health-related programs such as alcohol and drug treatment centers or stop smoking programs, and you may also deduct costs associated with participating in a weight loss program. However, the cost of purchasing diet foods through the program is not deductible. So, for example, if you join Weight Watchers and attend their monthly meetings and pay fees for that, those are deductible. But if you decide to attend Jenny Craig and you pay a small monthly fee for their counseling, but the much larger portion of the expenses associated with purchasing their food, the cost of the food you purchase through Jenny Craig is not deductible, but of course, the therapy or the education sessions through Jenny Craig would be. So how do you claim your medical expenses? Well, I've really already shown that. You claim your medical expenses on Form 1040, Schedule A, Line 1. Then on Line 2, you enter your adjusted gross income from Form 1040, Line 38. On Line 3, you multiply Line 2 by 7.5%. And then on Line 4, you subtract Line 3 from Line 1. If the result is greater than 0, you have allowable medical deductions. I'm going to give you the first password of the day. That password will allow you to open the Session 5 quiz answer key, and the password is Galactica, Galactica, Galactica. The next topic we're going to talk about is deductible taxes, and looking at Schedule A, those items are claimed in the second section of the Schedule A form, where you enter taxes that you may have paid. Now let's just take a look at these lines. Line 5 is where you enter state and local income taxes. You are invited to check box A or box B, but check one box only. Line 6 is where you enter real estate taxes. Line 7 is where you enter the new motor vehicle taxes from line 11 of the worksheet on the back of Schedule A. This is for certain vehicles purchased in 2009 on which you would have paid sales tax in 2010. A very small group of people qualified for that expense in 2010. And then line 8 is where you enter other taxes. So we're going to take each of these different types of deductible taxes in turn, beginning with income taxes and sales taxes. But the test to claim a deduction for any tax, there are two important rules that you have to apply. And the first rule is that the tax has to be imposed upon you, and the second rule is that the tax must be paid by you during the current year. So what does it mean to be imposed on you? Well, the tax must be imposed on your income or on property that you own. Taxes you pay on property you do not own are generally not deductible. The taxes must have been paid by you. Assuming you are a cash basis taxpayer, which nearly everybody is, you must pay the tax during the year for which you are filing. For example, if the tax is imposed on you in 2010, but you do not pay it until January of 2011, you cannot claim a deduction for it on your 2010 return. You will be able to claim a deduction for the tax on your 2011 return. Well, property taxes are one of the types of taxes that can be deducted, and I'm just going to use this as an example of a type of tax that can be imposed on you in 1 year, but not paid until another year. So each year, if you are a homeowner, you're typically going to be assessed a certain amount of property tax on your home and the land that it sits on, and you pay that property tax. Well, when you pay the tax is really important. You can receive an assessment in 2010, which is even due in 2010, but if you don't pay it until 2011, you can't deduct it on your 2010 return. And the thing is, many clients will bring in the bill, and what we as tax preparers have to think about is, did you pay the bill? So a bill being presented to you as evidence of a tax liability is great, but you also have to see evidence that it was actually paid during the year. And in the IRS audits that I have been in, it is universally the case that they not only look for the bill, they also look for proof of the payment during the year. Income taxes. You may deduct the following income taxes that you paid. State and local income taxes withheld from your wages during the year. State and local estimated taxes paid during the year can be deducted if you reasonably believed you needed to make the payments. You can deduct the amount of refund of state tax you choose to have credited to next year's estimated tax, and any balance due on income tax payments you paid to state or local governments during the year. Well, let's just think about this a little bit. So just to help you gain a better understanding of what we mean is deductible on the federal Schedule A, most individuals pay income tax at the federal level as well as at the state level. You are never allowed a deduction on the federal return for federal income taxes that you pay. What you are usually allowed to deduct, however, are taxes that you pay to your state. So I've just randomly selected 2 states from the United States to look at their tax returns just so that I can find the estimated tax line on those returns. The first state return I've pulled up is the Pennsylvania income tax return form PA 40. And I'm just going to scroll down this form until I get to the point where it shows the amount of refund that's being applied forward. So we can see here that if a tax return was prepared for Pennsylvania, the refund is calculated and entered on line 29, but there's an election that can be made on line 30 to apply part of the refund on line 29 to estimated taxes for 2011. Now, a 2010 Pennsylvania return would be filed in 2011 in most cases. So if you file your Pennsylvania return in 2011 and you want part of your 2010 refund applied to 2011 estimated taxes, then the amount of refund that you would apply would go on line 30. So let's just make up, say here, that we have a client who has a $400 refund coming from the state of Pennsylvania, and that we are going to make an election to apply all $400 of that to the 2011 estimated taxes. Well, what's going to happen is that the $400 estimated tax payment for California is showing on, not California, but for Pennsylvania, is showing up on the Pennsylvania form line 30. And when we prepare the 2011 Schedule A, this number can be entered as a deduction on the 2011 Schedule A. But let's just suppose that during 2010, this same filer had made estimated tax payments to Pennsylvania. So there is space provided on the form for payments that were made to Pennsylvania, and they could have come in the form of estimated taxes. So any estimated taxes that were either paid out in cash in 2011 or in 2010, either by cash or through application of the 2009 refund forward, would be deductible on a 2010 return. But an amount that is entered on the 2010 return to be applied forward to 2011 would ultimately go on the 2011 Schedule A. Now the next form I'm going to show you is the California Form 540. Form 540 also has a place to enter estimated taxes that are being carried forward. So you can see here on line 91 we enter the amount of refund, and then on line 92 we're able to enter the amount of the refund that we want applied to 2011 estimated tax. Now if I were to pull up the 2009 California return, and I can do that just real quick here to show you how that works, I would go to 2009 forms for California. Actually this is the Pennsylvania screen here, but that's fine. Let's find the Pennsylvania 2009 form. And here it is. So I open up the 2009 Pennsylvania return, and I'm going to find that same estimated tax line that we were looking at earlier. And here we see that we have the overpayment on line 28, and then we have the amount of refund that we want mailed, and then we have the amount that we want sent to pay estimated taxes. Estimated taxes that we're paying for Pennsylvania. So let's just suppose that the refund on Pennsylvania is $1,000, and that we want $600 of that refund to come to us in the form of a check, but we want $400 of that refund to be applied to 2010 estimated taxes. So this is a 2009 return being filed in 2010. The refund is $1,000, and of that refund we want $600 to be mailed to us, and we want $400 to be applied to the 2010 estimated taxes. What IRS is saying is that this $400 that was entered as an estimated tax amount on the 2009 return will be deductible on the 2010 federal return. So, just to reiterate, you can deduct the following income taxes that you paid: state and local income taxes that are withheld from your wages during the year. State and local estimated taxes paid during the year can be deducted if you reasonably believe you needed to make those payments. You can also deduct the amount of a refund of state tax you choose to have credited to your next year's estimated taxes, and also any balance due on income tax payments that you paid to state or local governments during the year. Here is an example. You made a $3,000 estimated tax payment to your state in January of 2011 for your 2010 state tax return, even though you knew this would result in an overpayment of the tax to your state. When you filed your state return in April 2011, you received a refund of $4,000. In this situation, you would not be allowed to claim a deduction for the estimated tax payment you made because ultimately you knew you didn't owe it. The sole purpose is to generate a deduction, and the money was refunded to you by the state. But here's another example. You elected to apply $500 of your refund from your 2010 tax return forwards to 2011 estimated taxes. Include the $500 payment as an itemized deduction on your Schedule A for your 2011 federal return. Example number 3, you filed your 2009 state tax return in April of 2010, and you had a balance due of $500. You paid the balance due before the end of 2010. You are allowed to claim a Schedule A deduction of $500 for the tax paid when you file your 2010 return. Refund of income taxes. Do not reduce the amount of your income tax deduction by refunds you received during the year. However, if you received a refund on taxes paid in a prior year, you should first establish if you benefited by claiming those taxes as a deduction in the prior year. If you received a tax benefit, the refund must be included as income on your Form 1040. You benefited if deducting state income taxes reduced your tax liability in the year you claimed the deduction. So here is an example of when you may not need to include a refund as taxable on your federal return. So example number 1, you did not itemize in 2010. You received a state income tax refund of $400 on your 2009 state tax return during 2010. Because you did not receive a tax-free benefit from deducting the taxes from your federal income, you do not need to report your 2009 state refund as income on your 2010 federal return. Example number 2, you did itemize in 2009. You received a full tax benefit from claiming your 2009 state income taxes as an itemized deduction on your federal return. You must include the $400 state refund received during 2010 as income on your Form 1040, line 10 for 2010. Example number 3. You did itemize in 2009, but you received only a partial benefit from claiming your state income taxes as an itemized deduction. You must determine what portion of state income taxes you paid that actually benefited you when you claimed them as a deduction on your 2009 Schedule A. Include as income only the amount of tax deducted that actually benefited you. And here's an illustration of what we mean. In April 2010, you filed a married filing joint 2009 tax return. Your itemized deductions that were claimed on Schedule A included charity of $1,000, state income taxes paid of $2,000, mortgage interest of $7,500, and property taxes of $1,100. Then in May 2010, you received a state refund of $1,000. Calculate the taxable portion of that refund as follows. The total itemized deductions that you claimed in 2009 were $11,600, but in 2009 your standard deduction was $11,400. So even though you deducted all of the state taxes that you paid and received a refund on 1,000 of them, only 200 becomes taxable because you would have been able to claim the standard deduction, and the difference between what you did deduct and could have deducted differed only by $200. Also, the taxable refund is the lesser of $200 or the refund that you received. In this example, the lesser amount is $200. You report $200 as income on line 10 of your Form 1040 in the year you received the refund. This calculation can be shown on the following worksheet, and I just wanted to draw your attention back to the 1040 and remind you about what we're talking about. What we're talking about is on the Form 1040, on line 10, we enter our taxable refunds. And so we're showing how we have determined the amount to enter on line 10, and the IRS actually has a worksheet for that called the State and Local Income Tax Refund Worksheet. We start with the amount of state refund received. We then look to the itemized deductions that were claimed. We're left with how much those the itemized deductions exceeded the standard deduction, and in this case, they only exceed the standard deduction by $200. So even though the state refund is $1,000, the maximum we're going to be able to or be forced to pay tax on is $200. You can also deduct foreign income taxes. You can claim an itemized deduction for foreign income taxes paid on income that is not exempt from U.S. tax because you claimed the foreign earned income or foreign housing exclusions. You may be able to claim the foreign tax credit also, but you may not claim the foreign tax credit and an itemized deduction for the same foreign tax paid. Remember the rule that no double deductions are allowed. Now, even if you did not work overseas, you may have paid foreign income taxes if you owned foreign securities through direct stock ownership or through a mutual fund. And in certain situations, I've also had clients who own real estate overseas. Optional deduction for sales taxes paid. You can elect to deduct income taxes or sales taxes as an itemized deduction on Schedule A. But note, if you bought a new motor vehicle after February 16, 2009, you may be able to deduct any state and local sale or excise tax paid on the purchase in addition to any state income tax you may have paid. But there are some important facts about the new motor vehicle deduction that you need to remember, and they are as follows. If you qualify to deduct both the state income tax and the sales tax paid on a new motor vehicle purchase, check box A on line 5 of Schedule A, right here, line 5A, and then also enter your deduction on line 8 for the sales tax paid on the new motor vehicle. If you elect to deduct income tax, check box A on line 5 of Schedule A and then enter the amount of state and local income taxes you paid on line 5. If you elect to deduct sales taxes, check box B on Schedule A. You can claim a deduction for sales taxes paid using one of two methods. Well, state income taxes paid is usually a pretty easy number to figure. You look at state withholdings on W-2s and you add to that any balance due paid to the state during the year as well as any estimated taxes paid to the state during the year. And you've pretty much got your state income tax deduction. But for sales tax, it's a little bit more complicated. There are two methods available, and the first method is to use the actual amount of state and local sales tax that you paid. To calculate actual sales taxes paid for the year, you would need to save all receipts showing the sales taxes that you paid for the year. And you can imagine that would be hundreds and hundreds of receipts for most people. Every time you go grocery shopping, pick up movie tickets, go out to dinner, you'd have to be saving your receipts and writing down the sales tax, keeping a record of that. And you might imagine that's a heck of a lot of work. So there is another method to simplify that, method number 2. And under method number 2, you complete the state and local general sales tax deduction worksheet, which is shown on the next page, using the optional sales tax tables. So we're going to spend a little bit of time orienting you with how to figure a sales tax deduction for a tax return that you own, and the IRS does have a worksheet for doing this. And it works as follows. On line 1, you find the state where you lived in 2010 on the optional state and certain local sales tax tables. These tables ask you to select the correct dollar amount using two pieces of information. Number 1, the number of dependents shown on your 2010 return, and number 2, the income shown on line 38 of Form 1040, plus any non-taxable income, such as tax-exempt interest, veterans benefits, non-taxable combat pay, and workers' compensation. Now, there's a few other things here as well, including non-taxable Social Security and railroad retirement benefits, non-taxable withdrawals from pensions, IRAs, or annuities, and public assistance programs. Why are all of these non-taxable income items part of the sales tax deduction calculation? Well, the answer is all of these provide money to you that you could have used to pay sales tax on items that you purchased. So if you use non-taxable sources of income to pay sales tax, then that non-taxable income is a factor on the worksheet. Now, if you were a part-year resident of your state, figure the amount to enter on line 1 by multiplying the amount from the table by your percentage residency as follows. For the first state that you lived in, enter the amount from the tables multiplied by the number of days you were in that state, divided by 365, which is the total number of days in the year, and that gives you your decimal ratio. You make the same calculation for state number B. And here is a working illustration of how that would work on the tax return. Mike is a single filer with income totaling $40,000, and during the year, Mark resided in the following states. He was a resident of Orange County, California from the first of the year through April 30th, and then he moved to Clark County, Washington from May 1st through December 31st. In March, Mike bought a new car. He paid $2,720 of sales tax on the boat at the time of purchase. Calculate Mike's sales tax deduction for 2010. Percentages from the sales tax tables are as follows, and we would look to the number of days he lived in California. There are 31 days in January, 28 days in February, 31 days in March, and 30 in April. That means he was in California for 120 days out of 365, and that gives us a ratio of 0.3288%. We then look to the sales tax table for California based on his income and filing and a number of exemptions. And we get $710, and that gives us, then 710 is multiplied by 32.88% to give us $233.45. So let me just scroll over to those sales tax tables so you can see what I'm talking about, where that number is coming from. That is the 710. Where is it coming from? And we go across the sales tax tables until we come to California. And here's California right here. We then look to his income, and we can see that there is a line for $40,000 of income. We then go over to California, one exemption. The amount on the table is $710. So that was the starting point for our filer. So that's where the $710 comes from when we do this calculation. So the percentage of that $710 that we're allowed to claim based on his residency is 32.88%, or $233.45. We next look at the period of residency for Washington: 31 days March, 30 in June, 31 July, 31 August, 30 September, and so forth. We end up with 245 days lived in Clark County, Washington. As a ratio of 365, that gives us 67.12%. And now we're going to go to those same sales tax tables, but we're going to look for Washington State instead. And we go through till we get to Washington. And here we have it, Washington. We're going to look for his income, which is $40,000 to $50,000, and that gives us 610 of sales tax for Washington. But of course we have to multiply that by the percentage of the year he lived in Washington. And when we do that, we end up with $409.43. We then add the $233 and the $409 to get $642, and this is the number that will go on line 1 of the worksheet. And by line 1 of the worksheet, I'm referring to the worksheet that I just showed you on the preceding page. This one right here, we're figuring the number to enter right there on line 1. Next step is figuring the amount to enter on line 2 of the worksheet. And the worksheet is essentially asking, were you a resident of any of these counties? Did you live, or states, did you live in Alaska, Arizona, Arkansas, California, that is Los Angeles County only, Colorado, Georgia, Illinois, Louisiana, Missouri, New York State, North Carolina, South Carolina, Tennessee, Utah, or Virginia? Well, the answer is no. Mike didn't live in any of those states. And if the answer is no, you enter a 0 on line 2, so that's what we're going to do. Line 3, did your locality impose a local general sales tax in 2010? If the answer is yes, enter your local general sales tax rate, but omit the percentage sign. Well, that's the next step in our formula. How would we figure out what the local general sales tax rate is? Well, there's two places you can do that. One is on the IRS website, and the other is just go directly to the county that you lived in or that your client lived in and research what the local rate is. So in terms of how that goes for our calculations, we have researched it and determined that the California state and sales and use tax rate for Mike in Orange County is 0.5%, and that the city local sales tax rate for Clark County is 1.7%. Then the worksheet says for line 4, enter the rates for the states that you lived in. And essentially, because Mike was in 2 states, we're looking up ultimately 2 rates. The rate for California is 8.25%, and the rate for Washington is 6.5%. But those percentages are then divided by, or divided into, the county percentages. So we take 0.5% for for Orange County and divide that by 8.25% for California to get this ratio of 0.0606. We do the same for Clark County. We take 1.7% county rate, divide that by 6.5% state rate, and we get 6.15. So then we go to this line 6 of the worksheet. We answer yes, multiply line 1 by line 5. We do the same thing for the Washington worksheet, and when we do that, we end up with a local California sales tax amount of 0.0606 times the state amount allowed based on residency of $233.45. That ultimately gives us a county sales tax deduction of $14. That same formula gives us a county sales tax deduction for Washington of $107.07. On line 7 of the worksheet rather, we now enter the sales tax that was directly attributable to big ticket items. And those include things like new motor vehicles, including cars, motorcycles, motorhomes, SUVs. Also, any state or local general sales tax paid for a leased motor vehicle, as well as sales tax paid on aircraft, boats, homes including mobile and prefabricated homes, or home building materials, if the tax rate was the same as the general sales tax rate. If the sales tax rate on any of these items is higher than the general sales tax rate, include only the amount of tax that you would have paid at the general sales tax rate. Do not include sales taxes paid on items used in your trade or business. So just continuing on with that worksheet illustration with a person who had residency in 2 states in the same year. Line 8 is asking you to add up lines 1, 6, and 7, and we would do that for each of the state worksheets. The California total general sales tax is $233.45 plus the state rate, or the county rate rather, for a net California worksheet amount of $247.60. On the Washington sheet, we enter $409 for the state rate, $107 for the county rate, and $2,720 for the sales tax paid on the boat. We get $3,236.50 at the state level for Washington. The next step is to add these numbers together. 247 plus 3236 gives us 3484, and that is the amount that will carry over to line 6. Not line 6, but line 5 of the Schedule A, and we would check box 5B. Now, it is possible to get the IRS website to do all of this hard work for you, and I've actually got some cutouts here from the IRS website where we've gone into their site and used their system to figure the deduction for us. You'll see that the IRS deduction of $34.84 is exactly what we came up with when we manually filled out the worksheets. The beauty of the IRS website is that it does all of this work for you. So I just wanted to draw your attention to the IRS website and how you would find the sales tax deduction worksheet built in. It's actually in the form of a calculator, and here I am on the IRS website, and I'm just going to type in sales tax calculator, do a search for that inside the IRS website, and you'll see here that they provide a link. I go into it, and there's some instructions for you to read. You then click on the link. It provides you with more instructions and then says click continue. And the first step is to select the year for which you want to claim a sales tax deduction. Then it says enter your range, and you're going to select an income range. Our filer was in the $40,000 range, and he's single. Then it says, did you pay any sales tax on specified dollar items? Going back to our problem, the answer is yes, we paid $2,720. So let's enter $2,720 right here. Then it says enter the zip code that you lived in during the year. Well, we'd have to know the zip codes for the counties that we lived in. And we can see here that for Costa Mesa, Orange County, we have 92626. So let's enter that. Select yes, Costa Mesa is where I want to go. Then we go continue. Did you move to a new residence in 2010? The answer is yes, our filer did. We go continue. How many times did you move? Well, once. Enter the zip code of the new residence you moved to. So let's just look that up. That was Vancouver, Washington, which is 98684. And continue. And that was Vancouver or Clark County. Enter the date that you arrived in Vancouver. We're going to select May 1st. Continue. And now it's just asking, is this the correct information? And we're going to say yes and continue. and we end up with this cutout that we inserted in the manual for you, and there is that deduction of $3,484. So of course this is a very useful tool available to you anytime you're trying to do a sales tax calculation. Now computer software can have these sales tax calculations built into them. However, I have found that when it comes to multiple states, like our illustration here, they're not necessarily very good. They seem to work just fine when you're in the same state the whole year, but when you move around, it's best to go to the IRS website. Here is another illustration of a simpler calculation and a more common calculation, which is a person lived in the same place the whole year. Sam and Jane are a married couple with 2 dependent children. They were residents of Clark County, Washington for all of 2010. Their income from Form 1040, line 38, plus non-taxable income not reported on Form 1040 was $80,000 for 2010. They paid $40,000 for a new SUV during the year. Figure the amounts to enter on their state and local general sales tax deduction worksheet. So step number 1 is go to the tables, look up their income and the number of exemptions for the state that they live in, and if you do that, you end up with $1,170, and that amount is entered on the worksheet. Line 2, they do not live in one of the states or counties mentioned, so you enter no and 0. Then on line 3, you enter yes and enter 1.7 because that is the Clark County general sales tax rate. Line 4 is the sales tax rate for Washington State, which is 6.5%. We divide the county rate by the state rate and get this decimal amount of 0.2615. We then check yes and multiply 0.2615 by the amount of state tax shown for their income and exemptions on the tables, and that gives us $306. We then add in the cost of a newly purchased vehicle. In this case, it was an SUV. $3,280 of tax was paid, and we're going to enter a total of $1,170 for the state, plus $306 for the county, plus the big ticket purchase item of $3,280. The net deduction is $4,756. We'll check box B on line 5A of the Form 1040 and carry $4,756 as the deduction being claimed. So here we have the completed state and general sales tax deduction worksheet for Sam and Jane, and we just wanted to show you how the worksheet looked filled out in its entirety for a particular filer. We have $1,170 as being the amount shown in the table for Washington based on their income and exemptions claimed. We then showed the Clark County rate of 1.7%, the Washington State rate of 6.5%. We divide 1.7 by 6.5 and we get 0.261538. We multiply the number on line 5 by the number on line 1 and we get $306. We then add in the cost of the big tax paid on the big ticket item. Then we add up lines 1, 6, and 7 and we get the ultimate deduction to enter on Schedule A on line 8. Here again are the tables, and you can see that they are divided by state. We have Alabama, Arizona, Arkansas. They're all in alphabetical order. Certain states like Oregon are completely missing because Oregon does not have an income tax. So if you live in a state with no income tax, obviously they would not be reflected in the tables. Here is the optional state and local sales tax table if you lived in one of the states mentioned for line 2. And if you did live in one of the states mentioned for line 2, there's no need to manually compute or figure the local rate. You simply see which local rate applies and then find that corresponding rate in the table and use the number from the table on line 2. So actual expenses versus optional sales tax tables. If you elect to use the actual expenses, you can deduct the actual state and local general sales tax that you paid. Using actual expenses would require you to maintain records of your purchases for the year, and tracking actual expenses could result in a higher deduction than using the tables. But tracking an entire year's worth of receipts would be a big job. Optional sales tax tables allow you to eliminate the need for keeping receipts, but can result in a lower deduction amount on Schedule A. So in summary, the tables give taxpayers a state sales tax deduction amount as an alternative to saving the receipts throughout the year and then tabulating the amount that was actually paid. Taxpayers use their income level and the number of exemptions to find the sales tax amount for their state. The table instructions explain how to add an amount for local sales taxes if they were paid. And taxpayers can also add to the table amounts that they paid for sales tax on big items like a motor vehicle, but only up to the amount of tax paid at the general sales tax rate, and also on aircrafts, boats, homes including mobile or prefabricated homes, or home building materials if the tax rate is the same as the general sales tax rate. The deduction for sales taxes paid will mainly benefit taxpayers who come from states that have state or local sales taxes but no income tax. These states include Alaska, Florida, Nevada, South Dakota, Texas, Washington, and Wyoming. Taxpayers living in states with both income tax and sales tax may find that they are able to claim a larger deduction for sales taxes paid than income taxes paid in years where they have purchased a new car or other large ticket item that boosts the total sales tax for the year. The next item in line is real estate taxes, so we are moving on now from line 5 for state and local income taxes onto line 6 for real estate taxes. Now, most people, when they talk about real estate taxes, they're thinking of property taxes that they pay on their home. I did want to point out, though, that real estate taxes are described as real estate taxes on line 6, and property taxes can also refer to personal property taxes. And if you were paying personal property taxes, those actually go on line 8. So for now, we're talking about the kind of property tax you pay on real estate that you own. And IRS, of course, describes that as real estate tax to be entered on line 6 of Schedule A. You may claim a deduction for taxes imposed on real property you own, provided the taxes are assessed based on the value of your property and are levied for public welfare. Taxes assessed to improve the value of your property are not deductible. For example, you are levied $2,500 to pay for sewer connections to your home. Because this levy is to improve your home, no deduction is allowed. The tax must be imposed upon the property you own and must have been paid by you. And here's a note for you to be aware of. You should carefully review the closing papers anytime you buy or sell your home. Your closing papers will show the prorated amount of property taxes that were credited to the buyer and seller. So one of the key reasons a client may choose to come to a professional tax preparer is because they purchased or sold their home during the year. And it's our job as tax professionals to be able to analyze and understand the information contained on closing papers. It's also our job to know what amounts that appear on those closing papers have an impact on the preparation of the tax return. Here is an example of what happens with real estate taxes when you buy and sell your home. You buy a new home in October of 2010, and then in November 2010 you receive your annual property tax assessment showing $2,000 as your July 2010 through June 2011 property tax levy. Because you did not own the home in July, August, or September, you must prorate your deduction to include only the portion of taxes actually assessed while you owned the property. If you own the property for 9 months of the assessed 1-year period, and the assessed tax is $2,000, then you're going to need to multiply the assessed tax by the percentage of time that you owned the home. And if you buy the home in October for an assessment period that runs July through June, then it means during that assessed period, you'll own the home from October through June, or 9 months. Now, some states and counties assess on a calendar year. And if you purchase a home in October for an assessment period that is calendar, that is January 1 through December 31, and you purchase the home in October, then you would really have only owned it for 3 months of the assessed period. So it's important to look at when you purchased the home, or in some cases when you sold the home, but also what the assessment period is to which the property taxes are being assessed. And in our illustration here, we have the home being assessed on a fiscal year, July 1 through June 30th. The home is purchased in October. That means the home is owned for 9 of the 12 months in the assessment, and that means that 75% of the taxes are deductible to the new owner, or in this case, $1,500. So here is a sample document and illustration for the seller of a home. Closing papers from a home purchase are illustrated on the next page. Examination of the document, that is the closing paper document, shows the close date of the sale is April 28, 2010. The property taxes were prepaid by the seller for the period of April 28 to July 1, 2010, a period of 63 days. And the taxes paid for that period are refunded to the seller when the sale closed. So $447.40 is shown as an adjustment item to the seller on line 107 of the closing papers. The annual taxes for the period July 1, 2009 through June 30, 2010 are $2,592. So here are two possible scenarios that would apply if you are the seller of the home. And again, we remember the rule that's about property taxes, or any tax is, that the tax has to be assessed on you. And also it has to have been paid by you during the year. So let's just say that you are the seller, that you paid your 2009 through 2010 property tax statement in November of 2009. Then you would have claimed the deduction on your 2009 return. And because you paid your property taxes in full in 2009, the deduction is claimed in full on the 2009 return. This means that any portion of the taxes that you paid that are later refunded to you because you sold the property would be included as income in the year you received the refund. So the taxable refund you should include on your 2010 Form 1040, line 10, is $2,592 of tax assessed, divided by 365 days in the assessed year, multiplied by the number of days that you paid that were refunded to you. And that gives us $447. Another option is that maybe you were assessed the taxes in 2009, but you didn't pay them all in 2009. Maybe you didn't pay them till 2010. Or maybe you paid them in installments. I live in the state of Oregon, and in the state of Oregon, taxes are paid 3 times a year. You can pay them all at once in November. You can pay some in November, some in February, some in May. Other states have assessments that are due twice a year, maybe in March and again in September. You really have to look at when your assessments are paid. And if you get a refund, is the refund for taxes that were paid in a year you've now deducted, or are they being paid in a year that hasn't been deducted? So there's a lot of thinking that goes into it. But let's just suppose you paid your 2009 through 2010 taxes in equal installments, and one payment of $864 was paid in November 2009. You paid another payment of $864 in February of 2010, and the third payment of $864 was paid in April of 2010. Well, since you only paid 1/3 of your taxes in 2009, you would have only been allowed to claim 1/3 of your taxes as deduction on Schedule A. Therefore, none of the taxes that are credited or refunded back to you are taxable as a refund. Not only that, since you paid the remainder of your taxes in 2010, you're going to be able to claim a deduction for what you did pay in 2010, as long as it's not refunded to you. So in 2010, you paid $864 in February. You paid another $864 in in April. But then $447 of that was refunded to you. So you net those out and end up with a deduction of $1,281 on the tax return as deductible for 2010. So here are the closing papers I was referring to that you do need to learn how to read. This is pretty much a standardized form called a HUD statement, HUD. And most of these statements have a very similar look, although of course they may not be identical. So we have the contract sales price of the home. We have the settlement charges that were paid for by the settlement charges to the borrower, that is the person who bought the home. And then we have adjustment for items paid by the seller in advance. And you can see here that we have county taxes for a period of April 28, 2010 through July 1, 2010. The proration is $447, and this is being refunded to the seller. And it usually is brought to the table by the buyer. So this amount would be income to the seller, or it would reduce deductible taxes to the seller. But because it's brought to the table by the buyer ultimately is allowed to deduct this, because it's for a period of time that the buyer will own the home, and it had to be brought to the table and paid for by the buyer. You can see that there's a deposit amount in here that has nothing to do with the tax return. We have a principal amount of the loan, nothing to do with the tax return. Really, when we go over to page 2 of the HUD statement, there could be more information that's relevant. And we'll take a look at page 2 when we get to deductible interest. So, to conclude, if you are the buyer regarding that illustration, you should claim $447 as a deduction for property taxes on Schedule A. If you purchased the home on April 28, 2010, and at close you paid $447 for real estate taxes that were owed for the period of April 28 through June 30th, then again in November you paid more tax, and this would be for the assessed period that would be July 1st, 2010 through June 30th, 2011, and at that time you paid an additional $2,652 of tax. Then as the buyer of the home, you would get the $447 from the closing papers that you paid at close when you purchased, and you would also get to take a deduction for the additional property taxes you paid in November of that same year. So the total deduction you would be allowed to claim on your 2010 tax return is going to be $447 from close plus the $2,652 you pay in November for a total deduction on line 6 of Schedule A in the amount of $3,099. Let's look next to personal property taxes. Most states impose personal property taxes on cars. And if you paid personal property tax on your car, you may claim the tax you paid as an itemized deduction. You cannot claim a deduction for licensing fees or registration fees of your vehicle. Here are some taxes, though, that you are not allowed to deduct, and they include fees and charges. Fees you pay for a driver's license or registration are not deductible. Also, transfer taxes. You cannot deduct taxes imposed on the transfer or sale of property, such as your home or car. Federal income taxes, Social Security taxes, and Medicare taxes. You cannot deduct federal income taxes, Social Security taxes, or Medicare taxes. The only exception to that is that you are allowed to claim a deduction for 1/2 of the self-employment tax you paid as an adjustment to income on page 1 of your Form 1040, line 27. But as you can see, that has nothing to do with itemized deductions on Schedule A. Fines or penalties. Penalties for violation of the law, such as parking tickets, late payment penalties, or speeding tickets, are not deductible. Also, licenses and fees, marriage, driver's and dog licenses, etc., are not allowed as an itemized deduction. So where to deduct the taxes you pay? When looking to deduct a tax, you must first consider the nature of the tax before you can determine how to claim a deduction. The following chart summarizes how to deduct most taxes that you might have paid. So we've summarized those into this table, and the first item is state and local income taxes. You deduct those on Schedule A, line 5, and check box A. Foreign taxes are claimed on Schedule A, line 8, or Form 1116 if you are claiming a credit. So if you're claiming foreign taxes, you enter those on line 8. Real estate taxes are entered on Schedule A, line 6, but personal property taxes are claimed on Schedule A, line 8. Real estate and personal property taxes that are assessed on your rental property are claimed on Schedule E. Real estate and personal property taxes assessed on your business are claimed on Schedule C, assuming you are filing as a sole proprietor. Self-employment tax, you are allowed to deduct 1/2 of that on Form 1040, line 27. And any other deductible tax you may have is deductible on Schedule A, line 8. There is that special new motor vehicle sales tax that applies to a very small number of people who would have purchased a new car in 2009 but paid the tax or the sales tax on it in 2010. And if that applied to you, then you would enter that tax on Schedule A, line 7, or on Schedule L, line 7. Schedule L is for certain individuals who are able to claim an increased standard deduction for those sales taxes. And finally, state sales tax paid, that is claimed on Schedule A, line 5B. The next item of the day is interest expense. Interest expense is claimed in this portion of Schedule A, and the interest expenses that we're going to talk about are home mortgage interest and points reported on Form 1098, home mortgage interest not reported to you on Form 1098, points not reported on 1098, mortgage insurance premiums, and investment interest. So in general, you may deduct only 2 kinds of interest on Schedule A. Other types of business-related interest are not a part of today's discussion. You can claim a deduction for interest you pay on your first or second home mortgage. You can also claim a deduction for investment interest to the extent that it does not exceed your investment income. Home mortgage interest. Interest you pay on a loan that is secured by your home or your second home is home mortgage interest. And to be able to deduct it, you have to meet the requirements. The first requirement is that you must file Form 1040 and attach Schedule A. Also, you must be legally liable for the loan, and there must be a true debtor-creditor relationship between you and the lender. The mortgage must be a secured debt with your home offered as collateral for the loan. So what portion of my mortgage interest is deductible? Your mortgage is fully deductible to the extent that it fits into one of the following categories. 1, it is grandfathered debt. Mortgages you took out on or before October 13, 2010 are grandfathered debt. Home acquisition debt. Mortgages you took out after October 13, 1987 to buy, build, or improve your main home, plus any grandfathered debt that totals $1 million or less, $500,000 if you are married filing separate. Home equity debt. Mortgages you took out after October 13, 1987, other than to buy, build, or improve your home, but only to the extent that the total of these loans was $100,000 or less and totaled no more than the fair market value of your home, reduced by any amounts falling under 1 or 2 above. Half that amount, of course, if married filing separate. Special situations that you should be aware of. The following charges are deductible as home mortgage interest. Late payment charges on mortgage payments, mortgage prepayment penalties, prepaid interest. However, if you have prepaid interest, which we generally refer to as a loan origination fee, loan discount fee, or points, you must spread this interest as a prorated amount over the life of the loan. If you are a minister or you have a military housing allowance, even if you are exempt from tax on your housing allowance, you can still claim mortgage interest you paid as an itemized deduction. For divorced and separated individuals, if your divorce agreement requires you to pay the mortgage on a home that is jointly owned by you and your spouse, but you do not live in the home, 1/2 of the mortgage payment may be considered alimony, and you can deduct the half of the mortgage interest paid as an itemized deduction. So what we're saying under this divorced or separated individuals, you're married. You and your wife buy a house together. Or rather, you and your spouse buy a house together, and then you get divorced, and the wife keeps the house. So wife has house, you're still half owner of the house, but you're making full mortgage payment on the house. And what IRS says is that half that mortgage payment that you pay on that jointly owned house is alimony, because you're paying it for your spouse's share of ownership. And the other half of the mortgage that you're paying is for your share of ownership of the home, and the portion that is deductible to you would be the interest that you're paying on your half of the mortgage. So half deductible is alimony, the other half you would deduct the portion of that half that is mortgage interest. Points are also called loan origination fees or loan discount fees. And what I have found with my clients is if I ask them the question, did you pay any points when you bought your house or refinanced your house, they'll say no. And then I'll say, okay, are you telling me that you did not pay any loan origination fees or loan discount fees? And then they'll go, oh, I'm not sure. So essentially, I always want to see the closing papers, and the reason I want to see the closing papers is I'm looking to see if there's any points on there, because my clients usually tell me they didn't pay them when in fact they did. So general rule, points are a form of prepaid interest, and generally you must amortize points you pay over the life of the mortgage loan. There is an exception, however. You can fully deduct points in the year paid if you meet all of the following tests. Number 1, your loan is secured by your main home. You must amortize points you pay on your second home. Paying points is customary in the area in which you live. The points charged were not more than the points generally charged in your area. You used the cash method of accounting. The points paid were not a substitute for other common closing costs such as escrow fees, down payment, title fees, etc. The funds you provided at closing were at least as much as the points charged. You used your loan to buy or build your main home or to improve your main home. The points were computed as a percentage of the principal amount of your mortgage loan, and the amount is clearly shown on your closing or settlement papers. If you meet all of these tests, you can choose to deduct points paid in the year you pay them, or you may amortize them over the life of your loan. Under a refinancing situation where you are refinancing your mortgage, generally you must amortize points you paid to refinance your home, even if the new mortgage is secured by your main home. But if you amortize your points, you can claim a deduction for points as a prorated amount each year. If you pay your mortgage off early, you should claim a deduction for all remaining unclaimed points in the year you pay off the loan. Now let's see how points get paid. In certain situations, points might be paid by the person or party that are selling the home. If you buy your main home and the seller pays your points for you, you should deduct the points as if you paid them yourself. Your cost basis in your property is reduced by the amount of points the seller pays for you. If you are the seller and you pay points for the buyer, you may not claim the points you paid as a deduction. Points you pay increase your basis in the property and reduce your net profit from the sale. So let's look at another sample document and illustration. This time we're going to really be looking at page 2 of the closing papers, because page 2 is where we're going to see that breakdown for points. Property taxes on our closing statement were shown on page 1, and the prorated points or the points paid are shown on page 2 of this closing document. So the closing papers illustrated on the next page of our manual show that the buyer paid a loan origination fee in the amount of $1,519. Look at line 801 of the closing papers. Assuming this is a main home purchase, the buyers can deduct $1,519 on their 2010 return. These points may or may not be reflected in the Form 1098 mortgage interest statement issued by the mortgage lender, which is discussed next. If the points are reflected on the Form 1098 mortgage interest statement, you should still look at the closing papers to be sure the amount reported is correct, because I can tell you, a lot of the time it's wrong. So here we have the closing papers, and we're looking at line 801. To zoom in here a little. Your loan origination charge is 1%, and remember we had a loan amount of $159,000. And that, or actually it was a loan of $151,900 rather, and the percentage on the loan origination fee is 1%, and so that ends up being $1,519. So the total loan origination charges are $1,519. Now you'll notice later on those closing papers it shows items required by the lender to be paid in advance by the buyer, and we're showing a little bit more interest of $73. Please do not treat that as a point, because it is not a point. This amount ultimately should accurately be reflected on the 1098 for the year. If the 1098 is accurate, it may also show this $1,519 number, but very often that $1,519 number is missing off the closing papers or is a lesser number than what we see on the closing papers. So as a preparer, again, I emphasize that you should ask for the settlement papers, look for the settlement charges, and be looking for these points because they are deductible. And where do they go? Well, if the points are deductible and they are not reported on a 1098, then you would enter them on line 12, points not reported on a Form 1098. But if the points are deductible and they're reported on a 1098, then you would include them in the amount you enter on line 10 of Schedule A. So here is Form 1098. This form usually looks fairly similar when it's issued by the companies that issue them. W-2s often look different, 1099s often look different. 1099 INTs and other investment statements almost usually look nothing like the standardized format IRS issues. But the 1098 really usually does look pretty much like what you see in front of you. If you paid mortgage interest during the year, you should receive Form 1098. Form 1098 is generally issued when you pay your mortgage to a person or organization where the loan is considered part of a business operation. So if you have a seller-financed mortgage, usually a Form 1098 will not be issued, but if you're borrowing money from a bank or other financial institution, you should receive one. And it will show the amount of mortgage interest you received in that you paid in Box 1. Any points you paid on purchase of a principal residence should be reported on line 2, but as I said already, are frequently missed. If there was a refund of overpaid interest, that would appear in Box 3. Box 4 is for deductible mortgage insurance premiums, and Box 5 is used just at the discretion of the company issuing the statement. And sometimes these companies will show real estate taxes paid in Box 5 and sometimes not. You should report mortgage interest shown on Form 1098 on Schedule A, line 10. Seller-financed mortgages are not reported on Form 1098, and if you paid your mortgage directly to the seller, you are paying a seller-financed mortgage. You generally will not receive a 1098 mortgage interest statement and must provide additional information on Schedule A. If you are paying your mortgage as a seller-financed mortgage and you do not receive a Form 1098, you must do the following. Report the amount of interest you paid to the seller on Schedule A, line 11, right here. And then in the space provided on line 11 of Schedule A, provide the payee's name, Social Security number or employer identification number, and their address. And I have an illustration here of how that would work. We have an individual named Wilma Deering, and this is her Social Security number and her address, and then the amount of mortgage interest that was paid to her during the year. The next line of Schedule A we're looking at is the mortgage insurance premium line, and that is line 13. You may be able to treat mortgage insurance premiums you paid during 2010 as home mortgage interest. The mortgage insurance must be paid in connection with home acquisition debt. The mortgage insurance contract must have been issued after December 31, 2006, and you must have paid the mortgage premiums before 2011 for coverage effective during 2010. You can deduct mortgage insurance premiums on Schedule A, line 13. There is, however, a limit on the deduction. This is a deduction really which is reserved for people who are considered to be moderate to low income. If your adjusted gross income on Form 1040, line 38 is more than $100,000, or half that amount if you're married filing separately, then the amount of your mortgage insurance premiums that are otherwise deductible is reduced and eventually phases out. You should see the line 13 instructions for Schedule A and complete the Qualified Mortgage Insurance Premiums Deduction Worksheet to figure the amount that you can deduct. If your adjusted gross income on line 38 is more than $109,000, half that amount for married filing separately, you generally are not allowed to claim a mortgage insurance premium as a deduction. And here is the worksheet. It simply asks you to enter the total premiums that you paid, your adjusted gross income, enter $100,000. If your income is more than $100,000, you're going to be allowed a partial or no deduction at all. And if your income is less than $100,000, then you ultimately are allowed to claim a deduction. If you are allowed to claim the deduction, you carry it over again to line 13 of the Schedule A. The next password of the day that I'm going to give you is the password to open the Session 6 homework answer key, and that password is Vancouver. So just jot that down. That says in Vancouver, Canada, VANCOUVER. So how to claim investment interest expenses. We're moving on Schedule A to the next line. Line 14, investment interest expense. And I'm going to just stop right here for a second and pull up a new form that we're going to need to analyze today. It's called Form 4952. I just want to get that handy for you. And here we have Form 4952, Investment Interest Expense. Form 4952 is used to figure the deductible amount of interest expense you can claim if you have a carry forward from a prior year, or if this year's investment interest expense exceeds your investment interest income. So in certain situations, you may be able to deduct investment interest expense without completing the form at all. And in other situations, you can claim investment interest expense, and you must also attach the form. Either way, regardless of whether 4952 is required or not, you still have to complete Schedule A and enter the deductions on Schedule A. And of course, Schedule A being right here, regardless of whether Form 4952 is required, you must still claim the deduction on Schedule A. So how do you claim investment interest deductions paid? Well, use Form 4952 to figure your investment interest deduction. Report your deductible interest expense on Form 4952 on Schedule A, line 14. You can carry your disallowed deductible interest expense forward to 2011, or you can claim a deduction for your investment interest expense on Schedule A, line 23, subject to the 2% limit on miscellaneous deductions. There is an exception to this rule. You can deduct all of your investment interest expense, and you do not need to complete Form 4952 if you meet all of the following tests. Number 1, your investment interest expense is not more than your investment income from interest and ordinary dividends. You have no other deductible investment expenses, and you have no disallowed investment expense from 2009. So what is qualified investment interest? Investment interest is interest you pay on money borrowed for investment purposes. If you borrow money to purchase stock or other investment property, you have investment interest. There is a limit on your investment interest deduction. Generally, your deduction for investment interest is limited to the amount of your net investment income. And your net investment income is income you derive from property you hold for investments. The income can come from interest, dividends, annuities, and royalties. Net investment income does not generally include net capital gains income or qualified dividends. However, you can choose to include all or part of this income in investment income by filing Form 4952 and reporting the elected income on line 4G. If you choose to include any amount of your net capital gain income and/or qualified dividends in investment income, then that portion you treat as investment income is not eligible for the lower 15% capital gain rate. Before making either choice, you should figure your tax on capital gains with and without Form 4952, line 4G income, to figure your lowest overall tax. And here is an illustration of how that would work. In our illustration, we have Austin Powers, who has the following investment and capital gain income for 2010. He's received a 1099 INT showing Box 1 ordinary interest of $100. He also has a 1099 DIV showing Box 1A ordinary dividends of $300 and Box 1B qualified dividends of $200. I just want to point out and remind you that the $200 is included in the $300. So essentially what we're saying is that we have $100 of interest and $100 of ordinary dividends and $200 of qualified dividends. And then we have 1099 DIV with Box 2 capital gain distributions of $300. So ultimately we have investment income of $400, but $200 of that investment income is technically not investment income. So that would leave us with really only $200 of investment income. And on the capital gain side, we have $200 of qualified dividends plus $300 of capital gain distributions. So ultimately we have $500 of capital gain income. So let's take a look at what's going on here. Austin's 2010 investment interest expense is $800, and his carryover from 2009 is $100. Prepare his Form 4952 as follows. So the first part of the form asks you to enter his investment interest expense, and in the wording of the problem right here, I told you that's $800. So we enter $800 on line 1. He had a carryover from 2009 of $100, and we enter that on line 2. So we ultimately have total investment expense for the year of $900. The next step is to enter the numbers on the worksheet as described. And on line 4EA, it says, enter your gross income from property held for investment purposes. And that ultimately is the $400 from ordinary interest plus ordinary dividends. We enter that on line 4A. But then on line 4B, it says what portion of 4A is attributable to qualified dividends, and that's $200. So we enter the $200 on here. Subtract 200 from 400, and we're back to that $200 true investment income that I mentioned. Then on line 4D, it says enter the net gain from disposition of property held for investment, and that's this capital gain distribution right here of $300. We enter that on there. Now, it is possible to make an election to treat capital gain income as investment income, and that's what we're going to do. And ultimately, the total capital gain income that we're going to choose to treat as investment income is $500. So we enter that on line 4G. We add the $500 of elected income to the $200 of actual investment income, and that gives us $700 of total investment income. But since the investment expense is $900, ultimately our deduction will be limited to $700, and we're going to have a $200 carry forward to 2011. So where to deduct interest expense? Well, we got the type of interest and where to deduct it. Student loan interest is the first type of deductible interest, and we mentioned that when we were covering adjustments to income in our last class. If you have student loan interest, you enter that on Form 1040, line 33, or on Form 1040A, line 18. If you pay deductible home mortgage interest and points that are reported on a Form 1098, you enter those on Schedule A, line 10. But if you pay deductible home mortgage interest that is not on a 1098, you would enter that on Schedule A, line 11. If you have points that were not reported on Form 1098, those go on Schedule A, line 12. If you have mortgage insurance premiums that you paid and they are deductible, they go on Schedule A, line 13. If you have investment expense that was not incurred to produce rents or royalties, you enter that on Schedule A, line 14, and attach Form 4952 if it is required. If you have business interest that is non-farm, you would enter that on Schedule C or Schedule CEZ. If you have farm business interest, that goes on Schedule F. If you have interest that is incurred to produce rent or royalties, that is deducted on Schedule E, and any other form of personal interest, such as auto loan interest or credit card interest, is not deductible at all. Next up, we have charitable contributions. You can deduct your contributions that you pay to charity, and by the way, let's just look at where charity goes on here. We're up to this section of Schedule A. We have gifts by cash or check. And it says, if you made any gift of $250 or more, see the instructions. We'll tell you what that's about. Line 17, other than by cash or check. So this would be donations of property you own. And if any gift is over $250, see the instructions, and we'll tell you what to do with that. And in certain situations, it says you must attach Form 8283 if your non-cash contributions are more than $500. And then there's rules regarding carryovers from prior years. So we're going to discuss all of that next in our class. So let's move on with a discussion of charitable contributions. You can deduct your contributions to charity only if you make them to a qualified organization. To become qualified, an organization must generally apply for nonprofit status with the IRS. You cannot deduct a cash contribution, regardless of the amount, unless you have a record, such as a canceled check or bank statement showing the name of the charity, the amount paid, the date, or written communication from the charity. Note that if you made cash contributions after January 11, 2010 and before March 1, 2010 for the relief of victims of the January 12, 2010 earthquake in Haiti, and you deducted that contribution on your 2009 return, you cannot deduct it on your 2010 return. So essentially what happened is when, and this has happened historically a few other times as well, there is a major event in the world. The United States Congress meets and says this event happened during the tax season. People are making donations to these charities, and we want to encourage them to do that. And if they do, they're going to be able to claim deduction on their current year return, or on the current return they're filing, even though the charity is being given in 2010 rather than in the 2009 year. So that's a very unique situation, and in this case we're applying to Haiti only. It happened one other time that I can think of off the top of my head, and that was Hurricane Katrina. Contributions from which you benefit. You cannot claim a deduction for a contribution you make to an organization to the extent that you benefit from the contribution. If you purchase an item from a charitable organization, you must subtract the value of the item you purchased from the purchase price. You may claim a deduction to the extent that you paid extra for the item only. For example, you purchased 2 tickets at a charity auction. The tickets are valued at $100, but you pay $150. This means you can claim a charitable deduction of $50. Membership fees or dues paid to qualified organizations. You can deduct the cost of membership fees that are $75 or less. You can deduct a larger amount only to the extent that you do not receive additional benefits solely because of the higher dues. If you pay extra to receive extra benefits, you must subtract the value of those benefits from your charitable deduction. You can pay more than $75 and receive a deduction for more than $75 as long as you do not receive additional benefits not available at the lower membership cost. And here is an example. You obtain a family membership to the zoo for $74 per year, even though you are entitled to free admission to the zoo with your membership. Because the cost of the membership is $75 or less, you can claim a deduction for the membership fee. Here's another example. You obtain a $500 zoo membership as a special sponsor. You gain additional privileges of nominal value. You can claim a $500 deduction for your zoo membership. A written statement is required if the payment for benefits is greater than $75. Generally, the charitable organization you donate to is required to give you a written receipt that breaks down the amount of your contribution from the value of the benefits you receive. Certain exceptions do apply. You should refer to Publication 17, page 159, Written Statement, for specific information. Let's also look at some other types of expenses you might have paid out, including deductible volunteer expenses. Expenses for students living with you under a written agreement with a qualified organization are the first type of volunteer expenses we'll talk about. You may be able to claim a deduction of up to $50 per month per student enrolled in the 12th or lower grade. The student, however, cannot be related to you and cannot be your dependent. The student must be attending school full-time, that is 15 or more days in the month claimed, and you cannot deduct the cost of a foreign student living in your home under a mutual exchange agreement in which your child goes to live with a foreign family. You can also deduct volunteer expenses that you incur while giving services to a qualified organization. You may be able to claim a deduction for out-of-pocket costs you incur while engaged in volunteer activities. The costs must be unreimbursed, directly connected with the services you provide, expenses you incurred only because you provided the services, and are not personal living or family expenses. So some examples of the types of volunteer expenses you may incur include conventions. If you are a chosen representative of the qualified organization, you may deduct your travel and meal expenses directly related to your official duties for the organization. You may not deduct the cost of personal activities or the cost of bringing family members with you, however. Uniforms. The cost of uniforms you must wear while performing donated services and which are unsuitable for personal use may be deducted. Examples of deductible uniforms include choir robes and volunteer firefighting gear. Foster parents. If you care for a child placed with you by a qualified organization, you may be able to deduct expenses that are unreimbursed, out-of-pocket expenses to feed, clothe, and care for the foster child, and are mainly to benefit the qualified organization. But expenses you incur caring for a foster child you intend to adopt are not deductible as a charitable expense. Car expenses. Car expenses you incur while providing volunteer services to a qualified organization can be deducted. You can claim the actual cost of gas and oil, but not the cost of repairs, maintenance, or depreciation. Or you can claim a standard rate of 14 cents per mile. You can deduct the cost of parking and tolls, and you must keep written records to prove your expenses. You cannot deduct the cost of driving to church unless you go to church on official business as a volunteer. Travel expenses you incur while providing volunteer services to a qualified organization. You must be performing services for the qualified organization. There can be no significant element of personal pleasure, and the trip must be substantially for duties you are performing for the organization. If you have only nominal duties, or if significant portions of your time are not spent performing your duties, you may not claim your travel expenses as a charitable deduction. So let's look at some items that are examples of non-deductible contributions. Firstly, contributions to individuals. You cannot claim a deduction for contributions you direct towards the benefit of a specific individual. Private individuals may benefit from your contribution so long as you do not direct that the contribution be given to that individual. And let me give you an example here. Let's just suppose that you have a soft spot in your heart for homeless people. And so when you have someone who asks for money on the side of the freeway, or you're downtown shopping and someone asks you for money, you give it to them. Well, that is an example of a non-deductible charity. You are giving a gift to a person, but that person is not registered with the IRS as a charity, and you cannot claim a deduction for what you give them. By the same token, let's just suppose you do give your money to a registered charity, but you direct that the charity spend the money for the benefit of a specific individual. If you do that, then the deduction is not allowed. Contributions to non-qualified organizations. You cannot deduct a contribution given to an organization that is not qualified to receive tax-deductible contributions. Examples of non-qualified organizations include homeowners associations, labor unions, civic leagues, chambers of commerce, and political organizations or candidates. Contributions from which you benefit. You cannot claim a deduction for contributions you make to a qualified organization to the extent you receive benefits in return. Examples of non-deductible benefits include child care, raffle tickets, tuition, contributions directed towards lobbying for legislation, etc. The value of your time or services. You may not claim a deduction for the value of your time or your lost income. Logically, this is because the time or lost income has not been included in your income in the first place. You can only claim deductions for things that have been taxed to begin with. So if the income was never taxed, you can't claim a deduction because it was never taxed, right? Cost of meals. Unless your volunteer duties require you to be away from home overnight, you cannot claim a deduction for the cost of meals. Adoption expenses, the costs associated with adopting a child are not deductible. However, you may be able to claim an adoption credit, and we'll get to adoption credits later in our course. The next area we're going to talk about is non-cash contributions. Everything we've been talking about up until this point is considered to be cash. So cash contributions include cash check and also volunteer expenses that you paid. Non-cash contributions are other contributions to charity of non-cash type items, and those are entered on line 17 of Schedule A. Now, generally, you can claim a deduction for a non-cash contribution for the lesser of the fair market value of the item you donate or your cost basis in the item. So how do you determine the fair market value of an item? Well, the IRS has published guidelines for assigning values to items in Publication 561. And you can divide things into two major categories. One of those is used clothing and household goods, and the other is cars, boats, and aircraft. Generally, if you donate used clothing and household goods, the fair market value of these items is much less than you paid for them in most cases. As a guideline for valuing these items, you should refer to IRS Publication 561 or visit a local resale store. The amount these items sell for at Goodwill or Salvation Army can be used as a good guide. Resale value is often higher than you might expect. For example, children's clothing can have a resale value of anywhere from $2 to $10. If you donated 10 children's garments and each one was valued at $6 and you donated those to Goodwill or Salvation Army, that would give you a $60 deduction that you can claim on your tax return. Another place that I go when I'm researching valuations is places like eBay and Craigslist, because I can see what people are asking for items on there. And in fact, I did have a client a few years ago who had a large amount of fairly high-value household items that she had donated to charity. And so I went online with eBay and I did research of thrift shops and really pinning down what I felt were the values on each and every item of significance that she donated to charity. And I printed out all of those valuations that I was able to find and basically kept those with her file. And coincidentally, she ended up being audited on that year, and the IRS accepted all of those comparison shoppings that we did because they were reasonable for us determining the deductions that she was claiming. Let's look at cars, boats, and aircraft next. If you donated a vehicle, including a boat or aircraft, to a qualified organization after December 31, 2005, your deduction is limited to the gross proceeds from its sale by the organization. This rule applies if the claimed value of the donated vehicle is more than $500. However, you generally can deduct its fair market value if the organization makes significant intervening use of the vehicle, materially improves the vehicle, or transfers the vehicle to a needy individual in direct furtherance of the donee's charitable purpose of relieving the poor and distressed or underprivileged who are in need of a means of transportation. These rules apply to donations of boats, aircraft, and any vehicle manufactured mainly for use on public streets, roads, and highways. There is an acknowledgement that is required for car donations, vehicle donations. It is a Form 1098-C. You cannot claim any deduction above $500 for a donated vehicle, boat, or plane unless the recipient charity provides an acknowledgement on Form 1098-C, which must be attached to your return. If you did not receive Form 1098-C, you cannot deduct more than the $500 of your contribution. And I'll show you real quick a 1098-C because it is in the manual at the back under classwork. So let's get to it. Actually, is it homework? There it is. It's actually under homework for session 7, and that is on page 49 of your manual. Here is an illustration of a 1098-C. You can see that a donation was made to the March of Dimes, and the March of Dimes has issued this 1098-C. It describes the vehicle, the date that it was donated, and the proceeds that the vehicle got at auction. So this is the amount that this individual can deduct on Schedule A. Okay, here we are. Next up is donations of inventory. These rules do not apply to donations of inventory, that is the 1099-C rules, or 1098-C rules. For example, these rules do not apply if you are a car dealer who donates a car that you had been holding for sale to customers. Giving property that has decreased in value. You can claim a deduction for an item's fair market value only, even if that is less than what you paid. So let's take a look at clothing and household items first. You cannot take a deduction for clothing or household items you donate unless the clothing or household items are in good used condition or better. Household items include furniture, furnishings, electronics, appliances, linens, or other similar items, but household items do not include food, paintings, antiques, and other objects of art, jewelry and gems, or collections. Now, I did want to point out this rule up here that says you can only claim a deduction if the item is in good used condition or better. I've always thought that was a rather silly rule. It's a relatively new rule. It's been around for a few years now, but when I first got in the business, it definitely wasn't there, and it was not there until more recently. But this is a judgment call. It's, what is your opinion of its condition? And IRS says that it has to be good used condition or better. But once you've donated the item, how would anyone know what condition it was in other than the testimony of the donee or the donor? So to me, it's a silly rule, but it is something you should discuss with your clients. Now, IRS says it has to be in good used condition or better. What was the condition of the property you donated? And if they tell you it was terrible, then don't give them a deduction. If they say, oh, yeah, it was in good condition, then that's what you've got to go on. Appraisal for items of more than $500. You can take a deduction for a contribution of an item or clothing or a household item that is not in good use condition or better. If you deduct more than $500 and pardon me, appraisal for items of more than $500. Appraisal for items of more than $500. You can take a deduction for a contribution of an item of clothing or a household item that is not in good use condition or better if you deduct more than $500 for it and include a qualified appraisal of it with your tax return. Giving property that has increased in value, ordinary income property. You can deduct your basis or cost in the property only. Ordinary income property is property that, if it was sold, would be treated as ordinary income or as short-term capital gain income. Examples include costs of inventory or business goods you donate, cost of artwork or manuscripts you created, capital assets such as stock investment property which you owned for less than a year, capital gain property. Generally, if you donate stock or investment property held for more than a year, you can claim the fair market value as a deduction. So limits on the deduction. This is certainly an area that you're likely to get tested on, and we make sure we drill it into you, not just in today's lecture, but also in our quizzes. There is no limit on the amount of the deduction you can claim if your total cash or non-cash contributions are 20% or less of your adjusted gross income. However, if your contributions total more than 20%, certain restrictions apply. Your deduction can never exceed 50% of your AGI. Your deduction is limited to 50% of your adjusted gross income if you make your cash or non-cash contributions to a 50% limit organization. Most qualified organizations are 50% limit organizations. Even if you contribute to a 50% limit organization, your deduction will be limited to 30% of your AGI if you contributed capital gain property, except if you choose to claim a deduction for the adjusted basis rather than the appreciated value of the property. And we also have 30% limit. If your deduction for cash or non-cash contributions cannot exceed, your deduction for cash or non-cash contributions cannot exceed 30% of your AGI if you gave to a qualified organization that was not a 50% limit organization. Veterans organizations, fraternal society, nonprofit cemeteries are examples of 30% limit organizations. If you gave appreciated capital gain property to a 50% limit organization, then your deduction is limited to 30% of your AGI. And finally, 20% limit. This limit applies to all capital gains contributed to non-50% limit organizations. So we have a summary of these deduction limits, and the table really helps make it easier. If the property you donate is cash or non-cash, then the deduction is limited to 50% of your AGI if you give it to a 50% limit organization. If you give capital gain property, the deduction is limited to 30% of your AGI if you give it to a 50% limit organization. If you donate cash or non-cash property, the deduction is limited to 30% of your AGI if you give it to a 30% limit organization. But if you donate capital gain property, then the deduction is limited to 20% of your AGI if you give it to a 30% limit organization. Carryovers of disallowed contributions. There is a line to carry over or claim a carryover of a disallowed deduction. And you can see right here on Form Schedule A, line 18, you can enter a carryover from a prior year. So what would happen is, let's just suppose you donated property to a organization that has a limit. So let me just kind of pull up an example here. You donate $20,000 of capital gain property to a 30% limit organization. Okay, and let's just suppose that your AGI is $50,000. So you've donated $20,000 to a 30% limit organization, and it popped away on me. So how are we going to calculate our limit? Well, we're going to look at what is 20% of our AGI, because if we donate $20,000 to a 20,000 of capital gain property to a 30% limit organization, it means our deduction will be limited to 20% of our income. 20% of $50,000 is $10,000. So that means we would have $10,000 we would be allowed to deduct, but we would also have $10,000 that would be non-deductible. So let's look at record keeping next. Oh, actually the carryover rules next. If you are unable to claim a full deduction for your charitable contribution because it exceeded your adjusted gross income limit, you can deduct the excess in the next year. You can carry your deduction forward for up to 5 years. And records that you need to keep. This is a very important feature or rule, and you should discuss it with your clients. To deduct any charitable donation of money, even if it is only $1. So let's just suppose you've got the Salvation Army Santa Claus ringing the bell at Christmas time and you donate $1 into that can. Even though the donation is only $1, you must have a bank record or a written communication from the charity showing the name of the charity and the date and amount of the contribution. A bank record includes canceled checks, bank or credit union statements, and credit card statements. So either you're going to have to get Santa Claus there ringing his bell to give you a receipt, or you should be donating through a check to the Salvation Army rather than sticking money in the bin. Another example would be you go to church and you've got the Sunday service and you're putting money in the basket as it's being passed around the congregation hall. You should put that money in an envelope with your name on it so the church can make a record that you made the donation, and then at the end of the year give you a receipt, or you should put a check in the bin so that when that check clears you have evidence that the donation was made. Bank or credit union statements should show the name of the charity and the date and the amount paid. Credit card statements should show the name of the charity and the transaction posting date. Donations of money include those made by cash or check, electronic funds transfer, credit card, and payroll deduction. For payroll deductions, the taxpayer should retain a pay stub, Form W-2 wage statement, or other document furnished by the employer showing the total amount withheld for charity, along with the pledge card showing the name of the charity. So if you sign up to have a portion of each paycheck go to charity, and there are usually forms that you fill out at your place of employment, and you would check off the charities you want to donate to and write in the amount that you want to donate in a year. So let's just suppose that you decide to donate $120 per year to the United Way, and it averages out to $10 a month. You would typically fill out a form doing that, and then the form is something that you should keep a copy of for your records, and then at the end of the year you should have a year-end pay stub showing the amount that actually went out to that charity, and that would be considered satisfactory evidence of the contribution to that charity. For cash contributions of $250 or more, you must have a written confirmation from the qualified organization. You must obtain written confirmation by the time you file your timely return or by the due date, including extensions for filing of the return. Out-of-pocket expenses. If you have deductible volunteer expenses, you must maintain adequate records to prove your expense, and by the required date, obtain written acknowledgement from the organization that confirms you provided the services and what portion of your expenses were not reimbursed. Non-cash contributions. You must keep a written record of each item you donate, and the written record should show a description of the property you gave, the date of the contribution, the fair market value of the property given, the cost basis of the property given, the amount of the deduction you are claiming on your return, and you must get and keep a record or a receipt from the organization that shows the name of the organization, the date of the contribution, and a description of the property given. You are not required to obtain a receipt where it is impractical to get one, but you must still keep a written record, a note or journal of the donation. For example, Goodwill and Salvation Army are both nonprofit organizations that will set up collection bins, usually in the parking lots of supermarkets or department stores. And you can stop by those donation bins and dump in, a garbage bag full of clothes, for example. And IRS is saying that if it's an unattended drop site, no one's there to give you a receipt, you don't have to have one. But you still keep a journal or a written record of the items that you donated and the date that you donated them and what you think their fair market value was. And as long as the deduction for that particular drop that you were trying to claim is $250 or less, a receipt is not required. But when the drop goes over $250, then you would be limited to $250 without a receipt. So for non-cash contributions of $250 or more, if you donate items valued at $250 or more at any one time, you must keep a written record and obtain a written acknowledgement that includes a description of the items given and the value of any benefits you received in exchange for that donation. Now there's a second rule with regards to non-cash deductions, and that is when the total of all non-cash deductions goes over $500 for the year. And if you go back to Schedule A and look at the line, it says, line 17, other than by cash or check, if any gift of $250 or more, see the instructions, and that is you have to have a receipt and a written record. And if over $500, you must attach Form 8283. So that's what we're on to now, is the rules surrounding Form 8283. If your total non-cash contributions for the year total more than $500, you must do all of the following. Complete and file Form 8283 with your federal return. Provide the name and address of the charitable organization. Provide a written description of the items you donated, their cost to you, and their fair market value on the date that you donated them. Note that this rule applies whenever total non-cash contributions exceed $500 and not just when a single contribution exceeds $500. And here's an illustration. You donate used furniture to Habitat for Humanity. The fair market value of the furniture is $450. 2 months later, you donate books with a fair market value of $50 to the county library and $200 of used clothing to Goodwill. Even though no one contribution exceeds $500, all three charities must be separately listed on Form 8283 because the combined total of all non-cash contributions is greater than $500. So furniture, books, and clothing, the fair market value of those items is $700. That makes the form a requirement. So where do you deduct these contributions? As I've already shown you, you claim cash contributions on line 16 of Schedule A and non-cash contributions on line 17. And if the amount on line 17 goes over $500, attach Form 8283. You claim carryovers from prior years on line 18 of Schedule A. And here is an illustration of a completed Form 8283. We have generous taxpayer who's made the following donations: children's clothing, 3 car seats, and books. And over here in this section, we line up each of the dates with the line for the applicable charity. We show the date of the contribution, the date acquired, how the item was acquired, could be gift, inheritance, purchase, for example, the donor's cost, the fair market value, and how we arrived at that fair market value. And acceptable descriptions provided for in the IRS instruction include appraisal, blue book, thrift shop, resale, comparable sales, or auction. So here is a summary of the 8283 rules. All non-cash contributions must be reported on Form 8283 if the total of all non-cash contributions exceeds $500. You must provide the following information for each organization you made a non-cash contribution to. That is the name of the organization, a description of the property donated, the date the items were donated, the date the items were acquired, and the method used to determine the fair market value of the donated property. So that concludes the lecture portion of today's class. It's time to move on to our classwork assignment. There are 2 classwork assignments today. The first classwork assignment is going to ask you to take your mind back to the very first part of today's class where we talked about medical expense deductions. And we're asking you here to determine which of the following can claim a medical deduction. So please push pause, complete classwork 1, and then we will do a review of the classwork 1 answer key. So I have up in front of you now the answer key for the classwork 1 assignment. And if you have not finished this assignment, please push pause and then watch this review. But if you are ready, here it is. Question number 1. Mary is the non-custodial parent of Jeffrey. Jeffrey qualifies as a dependent and is in the custody of one or both parents for more than half the year. Mary paid a $500 medical expense bill for Jeffrey. Can Mary claim a medical expense for or medical deduction for this expense? Well, the answer is yes. Mary can claim a medical expense because that she paid for her son if Jeffrey receives more than half of his support from his parents and is in the custody of one or both parents for more than half the year. So even though Mary does not get to claim Jeffrey's dependency exemption, she's still allowed to claim his expenses. Number 2, Mr. and Mrs. H incurred medical bills for their dependent child who died during 2010. Mr. and Mrs. H paid the bills during 2010. Can they claim a deduction for this expense? The answer is yes. You can claim expenses you paid for your deceased dependent or the spouse or your deceased spouse during the year that they died or after the year of death. Expenses are claimed on the year of the return or the return for the year in which the expense was paid. Number 3, Jane incurred a medical bill in April 2010, and then in October she married John. John paid Jane's medical bill for her in November. Jane and John will file separately. Who can claim the medical deduction on their return? Well, here we're looking at the date that she incurred the medical bill, the date they got married, and when the bill was paid. The bill was paid in November, and they got married in October. So John can claim the expenses because he paid the medical bill after they were married. But let's look at number 4 now. Assume the same as in question number 3, except John paid Jane's medical bill in June. Who can claim the medical expense deduction on their return? Well, in this case, no one. Because Jane did not pay her bill, she does not get to deduct it, and because John paid it before they were married, he cannot claim it either. The only way it could get paid in item number 4 is if they file a joint return. Then it would be deductible on the joint return. Moving on to classwork assignment number 2. Leonard Baker is married to Sue Baker. In March of 2010, the Bakers bought their new home, And they have their son, Mark, who lived with them all year. He earned $8,300, but his parents provided more than half the cost of his support. You can look at his date of birth. He is too old to be a qualifying child, and he earned too much to be a qualifying relative. But the question is, can they claim medical expenses they paid for him? Now, during the year, the Bakers had the following expenses. They have a 1099 INT with Box 3 interest. And Box 3 interest is what kind of interest? And City of Portland bond interest. They also have 1099 INT with Box 1 interest. And what kind of interest is that? They have a 1099 DIV with Box 1A dividends of $200. What kind of dividends are those? Then 2009 taxable refund received in 2010 was $400. They had unemployment compensation during the year for Sue in the amount of $2,500. Here we have a list of their deductible expenses, or they have a list of expenses, rather, and it is your job to determine if they are deductible. Mortgage interest reported on a 1098, is that deductible? Yes, it is. Qualified mortgage insurance premiums of $1,632. Are they deductible? Well, if their income is not too high, they should be. So you're going to have to look at their income and make sure that it's not too high. Property taxes paid in November for the period of July 1, 2010 through June 30, 2011 were $2,800, but they also paid property taxes on closing papers at the time they bought their house of an additional $1,200. And the answer is they'll be able to add both those numbers together and deduct them both. They also paid a loan origination fee that's showing up on their closing papers of $2,500. Is that deductible? Yes, it is deductible as points. Title and recording fees on closing, are they deductible? No, closing costs are not deductible. Medical bill paid for Mark, is that deductible? Yes, it will be. Pre-tax medical insurance, is that deductible? No, it's not. After-tax supplemental medical insurance, is that deductible? Yes, it is, because it's paid for with after-tax dollars. Sales taxes paid on a trip to Nevada, is that deductible? Well, if you're claiming the sales tax deduction, you could add that in if you're actually figuring actual expenses for sales tax deduction, but it's your job to establish if perhaps they're better off claiming the income tax deduction. And margin interest paid on an investment account, is that deductible? Well, margin interest is deductible as investment interest expense to the extent of investment income, so you're going to need to determine what portion of the $800 is deductible. Interest paid on land held for investment, is that deductible? The answer is yes, it is, but it is another form of investment interest. You can claim a mortgage interest deduction for mortgage interest paid on a second home, but a second home could not be held on vacant land now, could it? So if you have a vacant lot, you can't have mortgage interest on it that's deductible, but you might have investment interest. And finally, medical miles, 100 medical miles driven. How much is the deduction they get for that? The Bakers contributed $2,000 each to the traditional IRAs and received a Making Work Pay credit of $800. Go ahead and prepare the return. As we scroll down the page, we will see that they have a W-2 for $55,000, 401k deferrals of $3,000, retirement plan for Leonard Baker. And that's the total income there. So push pause at this point to complete classwork assignment number 2. When you are finished, please resume playback for a review of the classwork 2 answer key. So moving on with a review of the session 7 classwork 2 answer key. Mark cannot be claimed as a dependent on the tax return of his parents because he fails the gross income test under the qualifying relative rules, and he fails the age test under the qualifying child rules. However, he is a dependent of the Bakers for purposes of medical expense deduction, and therefore they can claim medical expenses they paid for Mark on their Schedule A. You should report the City of Portland bond interest on Form 1040, Line 8B. This interest calculation affects calculations for modified adjusted gross income and is required to be reported. The following expenses are deductible on Schedule A: the medical bill for Mark, after-tax supplemental health insurance, and medical miles. 16.5 cents times 100 miles equals $17 rounded, for total medical expenses that are allowable of $4,217. Now, the Bakers' medical deduction is reduced by 7.5% of their AGI, and by the time we finish their tax return, you will see that their AGI is $55,700, and 7.5% of that figure is $4,178. that means that their 7.5% of their income is almost as much as their medical expenses, and they ultimately end up with only a $39 deductible medical expense deduction. Property taxes paid in November, property taxes paid at close, and state income taxes withheld on the W-2s give them total tax deductions of $6,300. We then have mortgage interest, points paid on purchase, deductible investment interest turns out to be $1,800, and we'll show you where that number came from, and the qualified mortgage insurance premiums. This is the total deductible interest that they had. So let's take a look at the finished items on their return. Firstly, beginning with the Form 1040, we show W-2, $55,000, taxable interest of $1,600, and tax-exempt interest of $500. You see the City of Portland bond was tax-exempt, but we have U.S. bond interest and we have other ordinary interest of $900. When you add those together, you get $1,600. We have ordinary dividends of $200, and we have taxable refunds of $400. $2,500 of unemployment benefits gives us total income of $59,700, but we are allowed to claim an IRA deduction in the amount of $4,000. And it is not necessary to fill out a Form 8606 because their deduction is not limited. Their income is too low to be affected by phase-outs. So that's where the adjusted gross income of $55,700 comes from. Ultimately, we figured that their tax bill is $3,006. Their withholdings and credits are $4,800, and they ended up with a $1,794 refund. But let's continue on and take a look at their Schedule A. Here you'll see the total medical expenses, 7.5% of their AGI, and the deductible medical expenses. The income taxes withheld on their W-2s, combined with property taxes that they paid on their home, gives us $6,300. Their mortgage interest statement shows that they paid $10,500 of deductible mortgage expenses, and let's just find that mortgage statement. Actually, I didn't give you a mortgage statement. It's just in the wording of the problem, $10,500. We told you in the wording of the problem also that they had points that were reported on a form, not reported on a Form 1098 of $2,500, and the deductible mortgage insurance premiums, and finally the deductible investment interest expense. So their total itemized deductions were $22,771, and that carried to the Form 1040, page 2, and was entered right here on line 40. Then we have the Schedule B showing the interest income for the year, and we have $700 from U.S. Savings Bonds and XYZ Bank of $900, also the XYZ investment interest, and we answered no, as usual, to the foreign account questions. Here is Form 4952. We can show that the total investment income for the year is $2,800. Where did that come from? Well, we have margin interest on the investment account of $800, and we have interest paid on land held for investment of $2,000. The second part of the problem is to enter the gross income that comes from investments, and that ultimately was $700 of U.S. bond interest plus ordinary interest of $900 plus the dividend income, ordinary dividend income. Those total $1,800, and we ultimately therefore have a carry forward of non-deductible investment interest expense from 2010 to 2011. So that concludes the review of the Session 7 classwork answer key. Let's move on to your homework assignment. And your homework assignment involves preparation of a tax return for Dr. Hewer, who bought his first home as a contract sale from Wilma Deering. During the year, he took a home equity loan to buy a new boat, and he also took out a home improvement loan secured by his home during the year. Dr. Hewer has no idea what he can deduct and is hoping you can help him. And I've got a list of expenses that you'll need to sort through. The password, by the way, to open the Session 7 classwork answer key is PONY, P-O-N-Y. That is the third and final password I'm giving you today. Here is the income. Here is the expenses for Dr. Hewer. Here is his W-2. Please prepare his tax return. Homework B is a little bit simpler, involves a character named Angela Biggins. We just want you to do her Schedule A and prepare a Form 8283 for her. And we've given you a variety of items that she's donated to charity. Sort through those and have good fun. And thank you for attending Session 7 of the Basic Tax Course. I'll see you next time when we begin talking about casualty and theft losses and other miscellaneous deductions that are claimed on Schedule A. Thank you and bye-bye.